How to make a living trading foreign exchange. A guaranteed income for life. By Courtney D. Smith. Preface. Trading foreign exchange, Forex, is one of the most exciting and potentially lucrative activities in the world. Yet about 90% of traders lose money. This book is designed to create profitable traders. Can you make a living trading Forex? Yes. And no. Let me explain. It is common wisdom that about 90% of traders lose money trading Forex, about 5% break even, and about 5% make money. I have not seen any scientific evidence that this is true, but I have talked to senior executives at brokerage houses and they tell me that this is a rough guide to what happens to traders. My own experience as a senior executive in the futures and options industry also confirms the same dreary results. There was a study by the federal government back in the 1960s of futures traders, and they found that futures traders had those same statistics. However, the underlying data were not so dismal. It was true that 90% lost money, but that was after commissions. They actually had about a 7% return on their investment before commissions. The main reason that they were losing was commissions. The theory back then was that the 7% gain was the equivalent of an insurance premium that commercial companies paid to speculators to take over the risk of the commercials. Trading Forex does not incur any commissions, and futures commissions are much lower now, so I doubt that this factor is so important anymore. However, Forex does have other transaction costs in the form of the bid-ask spread. The cost of buying at the ask and selling at the bid on every trade is a significant drag on performance over a given year. Let's assume a $10,000 account trading mini contracts. Let's further assume that there is a 3-pip bid-ask spread for each trade. Now assume that we do almost 1 trade per day, or 250 trades per year. That comes to a $750 expense off the top of trading. We have to overcome that VIG each year to make a profit. We effectively start out in the hole by 7.5% when we start the year trading. We need to make at least 7.5% profit just to break even. I think those assumptions are similar to many traders. Take a look at your own experience to see where you stand and how much headwind you have to overcome to break even. It might actually be worse than that. The most common form of Forex trading is spot Forex through a retail Forex broker such as FXCM or Sterling Gent. Brokers take an additional profit from the roll every day. I'll explain what the roll is in Chapter 1, but please note that brokers effectively take a bid-ask spread every day. This is worth another, say, $3 per day per open position. Let's assume that you only have on 1 position per day, and that adds up to another $750 per year. We are now up to a 15% headwind to make any money. Stock investors tend to make money, but that is largely because the stock market drifts higher over any decent, long period of time, not because stock investors are better investors. In addition, there is no time limit when you invest with stocks. Futures and options expire. Forex doesn't expire, but the high leverage keeps people from hanging on to positions for years the way they can with stocks. Investors will often hang on to losing positions in stocks for years, waiting for them to return to profitability. That is technically possible in Forex, but it's rarely done. The high leverage creates a mentality toward trading that works against traders. Basically, trading Forex attracts a get-rich-quick mentality that works against the trader. Contrast this mentality with the normal stock investing mentality that looks to buy and hold. The pressures of dealing with high leverage cause the usual Forex trader to make a lot of mistakes. And those mistakes cost more than in the unleveraged stock world. The high leverage puts a lot of mental pressure on the Forex trader that is simply not there in as high a degree for a stock trader. The sum of all these differences is that the Forex trader has a much harder time making money than a stock trader. But the subtitle of this book is A Guaranteed Income for Life. This title was inspired by an infamous poker book from 20 years ago. I truly believe that the material in that book can create a guaranteed income for life. This is not BS. Here's what it requires. You must do exactly what I say to do in this book. You must not deviate. You must execute flawlessly. Only after you have mastered this material should you start to be creative. This self-discipline is critical to your success. A lackadaisical attitude will put you back in the category of a losing trader. You and I both don't want that to happen. I can't repeat it enough. Execute the plan in this book and you will be a profitable trader. You will live a life that few can even comprehend. I wrote much of this book while hanging out near the beach in Belize. I'm writing this preface on a plane to Singapore, where I will first give a speech to about 2,200 people and then relax in several Asian countries in beach houses. How can I do this? Internet access. That's it. I do all my analysis and trading online. I can't live in the real boondocks because I need internet access, but I can live a remarkable lifestyle anyway. My first stop after the Singapore speech is a week in Bali. Guess what? I don't even really need constant internet access. I really only need internet access for about 15 minutes a day. I prefer more than that because I post a lot of instructional videos on my educational websites and that takes more time and bandwidth. But how about just a few minutes at an internet cafe in China or London or wherever? That's all I need. The true goal for me, and most people trading Forex, is not to make a lot of money but to gain freedom. I know that I presented a rather dismal picture about how hard it is to make money in the Forex world. But I'm not only saying that you will make money, I am also saying that you can have a guaranteed income for life. This is a very strong statement. How do I know that this is true? How can I be so sure? I have spent many years training traders. I have been teaching these techniques for over 25 years. More important, I have been training retail investors with no experience at all trading, let alone trading Forex. It has been a very gratifying experience. I have really enjoyed watching people create a new life for themselves. Every single one of my retail educational clients has made money trading Forex, except one. And he is down just a little. At one point, I foolishly offered a mentoring program called Extreme Profits. This was a short but intensive program that I charged $2,000 to take. Here's the insane part. I offered a money-back guarantee if students didn't double their money in a year. What an idiot I am. All but one student doubled their money. These were normal retail investors, no trading pros in the group. The one woman who didn't double her money asked for her money back and I gave it to her. By the way, she was up 70% for the year. So I know that it can be done. I know that you can do it. But, isn't there always a but? You must execute flawlessly. That's it. That's the secret. Now go through this book. Execute the plan. Make money. Live the life you dream about. Overview of the contents. I've designed this book to be useful for anyone who is interested in making money trading Forex, from novice to pro. This book explains all the basics that a novice needs to know to get going. At the same time, experienced traders will find the systems and methods, particularly my enhancements of classic methods, to be of significant value. Every trader will find the sections on the psychology of trading and risk management will sharply enhance their profitability. Chapter 1 outlines the basic information you need to get started in trading Forex. Perhaps you've traded stocks or mutual funds or even futures. But I assume that you know nothing about trading Forex. I've also included a number of real stories of my trading, to give some flavor of the life of a professional institutional trader. Even if you have some experience trading Forex, this chapter is worth reading for the examples. Chapter 2 is where we really start the methods of making money in the Forex market. This chapter introduces trend analysis. This technique is similar to what have been called 123s. However, I add in a unique method to truly define which trends to jump onto and which ones to sidestep. In addition, I introduce to the public for the first time the Bishop technique. This unique indicator has a tremendous track record of getting out of trades at major highs or lows. It doesn't give a lot of signals, but you should pay very close attention when it does. I will exit all my open positions on any technique whenever I see a Bishop buy or sell signal. It's that powerful. I'm also introducing in this book a new way to filter trades. This filter eliminates about half of my losing trades while only eliminating about 5% of my winning trades. What a great trade-off! It dramatically enhances the profit of the trend analysis and other techniques. Chapter 3 is all about channel breakouts. This classic technique has been around since the 1960s. It's been around that long because it is that profitable. I'd estimate that most of the largest and most profitable Forex hedge fund traders are using some variation of this technique. However, I introduced several major enhancements to the classic technique that turbocharge the profitability. The first enhancement is the principle of instant gratification, which is an underlying principle that will show you how to greatly enhance your understanding of the market, how to profitably trade, and how to boost your profits. I also introduced the rejection rule. This powerful enhancement cuts the risk of trading channel breakouts by at least half, yet it retains all the profit potential. It basically monitors the health of a breakout and leaps out of the position if there is no follow-through. In addition, it cuts down on the psychological stress of trading channel breakouts. The concept behind the rejection rule can be applied to other trading methods. You won't want to miss this idea. I then add in another exit strategy called the last bar. I got this idea from ace trader Peter Brandt. It sharply reduces the risk in any given trade to a trivial amount. As you can imagine, cutting risk to small amounts dramatically enhances your profits at the end of the year. I introduced the Conqueror in Chapter 4. This is a truly unique trading system that was originally designed by legendary trader-analyst Bruce Babcock, enhanced by ace system researcher Nelson Freeberg, and finally tweaked by me. This system monitors the market from 3 different time perspectives and doesn't enter the market until all 3 are calling for an entry into the market. Another unique feature of this method is that it uses different exit techniques than the entry techniques. This is the only method I know that uses different exit and entry techniques. The Conqueror is a technique that has a very hard time entering the market. It wants all the conditions to be perfect before entering a trade but jumps out of the position at the slightest intimation of weakness in the trade. I love this system and I think you will, too. Chapter 5 introduces how to use stochastics profitably. It seems like everybody uses stochastics. They are perhaps the most popular indicator in chart services. Yet everyone is using them wrong. This chapter shows you how to profitably use stochastics while sidestepping the usual traps that drain money from your account. I show you how I use stochastics to identify short-term turning points and, more important, how to identify major turning points. As a bonus, I have included an amazing interview with the inventor of stochastics, George Lane. I had the privilege of interviewing him before he passed away. This hard-hitting interview reveals how he invented stochastics, where they got their name, and, most important, how George himself used stochastics to make money in his trading. He literally states that, used correctly, it is damned near infallible. This interview is priceless. Another unique feature of this book is that I show you different profitable techniques to use over different time horizons. The techniques discussed here are techniques that look at the market from the perspective of days to weeks. Chapter 6 introduces several techniques that trade over a much shorter term. These techniques hold positions for less than 1 day. These pattern recognition techniques are great for those traders who want to make money during the day rather than over the next week or month. I like to think about these trades as just churning out some nice profits day after day. No monster profits because you can't make monster profits in just a day. But making a nice chunk of money during the day is a very nice thing. This chapter also introduces the multi-unit tactic. This technique uses multiple contract positions to give you more flexibility in your exits. This technique has a lot of positive psychological benefits while also giving a kick to your profits. You cannot control the profit you make unless you control the risk in your account. You are doomed to losses if you don't control the risk in your account. 90% of Forex traders lose money while only about 5% make money. I argue that one of the critical differences between the winners and the losers is that the winners know how to control the risk in their account. Chapter 7 drills down on this important subject and gives you clear instructions on how to control the risk in your account to ensure that you will be a profitable trader. I even take risk management one step further and show you how to use it as an offensive weapon, not just a defensive one. The concept of using risk management as a method for enhancing profits is rarely talked about in the markets. This chapter is critical because you need to be able to survive the inevitable losing streaks without losing any significant money and to also be able to maintain the proper mental state. You must never get to a situation that is both financially and mentally debilitating. The next chapter, Chapter 8, shows a new technique called the slingshot as well as the mini slingshot. I also use this chapter to extend the discussion of risk management. The slingshot is a very interesting chapter due to the unique concepts embedded in it. It builds on the risk management concepts from the previous chapter. I believe that risk management is actually the second most important factor for investment success. Chapter 9 looks at the biggest block against making money in the markets, you. It is your psychology. You are the biggest problem. Intellectual skills are trivial. You will rarely have problems with the methods that I present in this book. The basic risk management rules are also easy to apply. But the psychology of trading is intense and few can master it. I want you to be a huge success. It is the real key to making money in the market. Please do not disregard it or push it to the side. I am laying out a lot of profitable techniques in this book. But you will not make any money with them if you don't have the proper psychology. For example, what good is a profitable method if you don't have the self-discipline to execute the trades on a daily basis? You will fail. You need to be able to execute the techniques or the techniques are useless. I am a big believer in stress-free trading. Why should I trade if I get all wound up in stress while doing it? I may make money, but I shouldn't trade if the stress is overwhelming. Life is too short. Once again, we need to deal with the psychology of trading. This chapter goes into the reasons people trade. No, it's not just to make money. I also go into all the reasons that people lose money and show specifically how to overcome those reasons. There may not be any sex appeal in dealing with our own psychology, but it is the most important factor for trading success. Chapter 10 shows you how all these techniques fit together. By this point, I will have shown you a collection of powerful techniques for making money trading Forex. This chapter shows how they all fit together into a coordinated program for profits. Each technique has a different purpose from the other techniques. So the totality of the techniques is truly greater than each technique separately. Once again, this is a very unique approach. Most books will present techniques but no framework. You should come away from reading this book with a concrete and comprehensive approach to making money trading Forex. You will have a toolbox full of profitable techniques. You will understand how to manage your risk. You will understand how to have a stress-free psychology of trading. Good luck. Chapter 1. The Basics of Foreign Exchange Trading. Foreign exchange is the most traded instrument in the world. Roughly $3 trillion is traded on any given day. Some days, volume can reach as high as $7 trillion per day. This volume completely swamps the global stock market. It is not hard to understand why Forex is traded the most. Nobody needs to buy stocks, but we must all deal directly or indirectly with the foreign exchange, Forex, world. Global trade is huge. Every time a barrel of oil is bought, dollars must also be bought by everybody but Americans. Japanese must change their yen into dollars to buy oil since oil is priced in dollars. Every time an American buys a Japanese car, dollars are swapped for yen to buy the car. Every time a kid watches a Disney movie in Poland, dollars are demanded. Cross-border capital flows for investment contribute another massive quantity of foreign exchange transactions. Perhaps the largest component of daily volume is speculation. This is mainly done by banks and other financial institutions around the world. Every day, banks trade among themselves looking for speculative profit. In addition, major banks try other strategies to make money. For example, a bank will try to find another bank that doesn't know the correct price for a currency and make a purchase. Perhaps a large order had come into a bank that was large enough to change the price of the currency. This piece of knowledge could create additional profit opportunities for the bank that knew about the order. This will be discussed later in this chapter. Let me assume that you know something about investing in general, perhaps in stocks, and focus on how the Forex market is different from other markets. Sell a yard of cable. I was the treasurer of the New York branch of a Swiss bank in the late 1980s. We had a client who was a cotton merchant from Turkey. He speculated in Forex as a paying hobby. Late one afternoon in New York, he called one of our dealers and placed an order to sell a yard of cable. Let me translate that into English. What he wanted to do was to sell 1 billion British pounds. The only currency that is capitalized is the pound, all others are lowercase. Forex trivia. We were shocked at the size of the order. That would be a huge order for any major financial institution, let alone for a single individual. We were the counterparty on all orders from our customers, so we were expected to take the other side of his trade. No way. We weren't big enough to take on such a large position. All foreign exchange trading, except for a small amount on the international monetary market, is over the counter. There is no exchange. All transactions are done over the phone, with a broker, or via some electronic means between two entities. Entities are usually financial institutions but are often corporations and sometimes individuals. That means that when a retail investor, such as myself, puts in an order through an online broker, the counterparty is practically unknown. It could very well be the broker. However, the broker could be aggregating prices from different brokers or institutions. The source of the prices are unknown, which is very different from the stock market because a stock is generally traded only at one place, such as the New York Stock Exchange, NYSE. Technically, the NASDAQ is an over-the-counter market that is centralized in one place, so it is, effectively, an exchange. Forex is completely diversified. Back to the yard of cable. The size of his order meant that we had to lay off the risk to other dealers. But there was no way that we could find a dealer to take the whole billion pounds. Even 100 million pounds was a large order. It was very late in the afternoon and I only had a few Forex dealers on the desk. My main trading desk was in the form of a large T with me at the top of the T. I could see and hear everything on the desk this way. I started grabbing dealers from other desks. It took a few minutes, but I soon assembled a cast of 10 Forex, bond, and cash dealers arrayed in front of me, 5 on each side of the bottom of the T. We knew that the pressure of selling 1 million cable was going to cause a sharp drop in the price of the pound sterling. It was a huge order. So, naturally, we sold $20 million for our own account. It didn't change the price at all. This is called front-running and is legal in Forex and bond trading but illegal in stock trading. I told each trader to call a different bank and get a price for 100 million pounds. In the interbank world, you ask for a price from the other bank. The other bank must offer you a two-sided market. This means that they must give you a quoted price for both buying and selling. So the other dealers might have said 43 to 45, which means that they are willing to buy pounds at 43 and to sell them at 45. Notice that 43 and 45 are not complete prices. The complete price might have been 1.6543 and 1.6545. But dealers only speak about the last two figures of the price. It is assumed that we all know the handle, or the big figure. Dealers don't waste time. In fact, the price of 43 to 45 was likely barked into the phone with the implication that we better quickly tell them whether we were buyers or sellers. I would often hear dealers say something like, 43.45, what do you want? Their quote is two-sided, both a bid and an ask, and is a push to trade. I told my dealers to raise their hand when they had a price. I gave them the sign to sell as soon as I saw my 10th dealer raise his hand. They all simultaneously said, yours, 100. Saying, yours, meant that the pounds were sold to the buyer and were theirs. We would have said, mine, if we were buyers. The 100 was the quantity that we sold them, in this case, 100 million pounds. We were able to sell all billion pounds that our client wanted us to sell. We sold them all at the current market price. But then all hell broke loose. The pressure from our order caused a vacuum to open up under the price. We may have sold a billion cable at 43, but the price was 100 pips lower in a fraction of a second. A pip is the smallest normal increment that a currency trades in, even though some brokers quote in tenths of a pip. A general rule of thumb is to start with the far left digit in a price and count to the right 5 places, and that is a pip. The yen under 100.00 is an exception. In that case, only count 4 places. Always ignore decimal places. Our phone board lit up like Times Square. All 10 of those dealers we had just sold to were screaming into the phone some variation of how we had stuffed them and how our parentage was suspect. They were screaming about how they were now holding a big position in pounds and had nowhere to lay off the risk since we had basically forced the market to go long. They now owned 1 billion cable and had no one to lay off the risk to since we had just swamped the market. We let the other dealers vent for a minute or two and then explained that we had no choice in how we handled the order. They all stopped venting and agreed that they would have done exactly the same thing, and there were no hard feelings. Indeed, we found ourselves on the other side of such a trade over and over again. This is financial Darwin in action. Now, remember, we sold short £20 million before we stuffed the market. We had a huge profit in that position now. I remember one of my traders saying to me that we just had a good year in the last minute. Yes, we made a lot of money on that trade. It was now time to mend some bridges. We could take that 20 million cable and go into the market and buy it back, thus taking our profits on the short position. We would dole out our 20 million to the dealers that had complained the least to reward their attitude. We couldn't offer a lot of relief, but we were the only bidders in the market at that point, so they were very happy to hear from us. On this trade, we were not trying to get the best price. With the client's order, we really wanted to get the best price. But for ourselves, we wanted to get out at a reasonable price and, at the same time, give back a little love to the market after we had decimated it. In this case, we called a few brokers and, after letting them rant a little more, told them that we were buyers of cable. That was a signal to them that they could move the price up a pip or two and make a little money on our order. Did I mention that trading Forex is the most cutthroat of all the major markets to trade in? Don't want to trade. I've always considered it one of my greatest trading feats that Deutsche Bank never traded with me. The Deutsche Mark was still being traded when I was a dealer. The euro came later. Deutsche Bank was the premier bank trading the mark. They were the big dog in the mark and really made the market for the mark. They had all the big clients, so they saw most of the flow into the market. I mentioned before that we would generally quote a market with both sides. If we quoted a price of 65 to 67, that meant that we would sell it to whoever called us for a price at 67 and buy it from them at 65. So, for example, another dealer would call me and say, "Price on mark." That's all. That meant that they wanted a price for me to both buy or sell the D mark. They don't tell me in which direction they want to go. They could be buyers or sellers. This process keeps the system fair. I have to give them a fair price since I don't know what they want to do. Otherwise, consider if I knew that they wanted to be buyers. I could then shade the price a little higher so they would have to bid up to my price to buy. That way, I would make a little more money. The two-sided quote keeps the market fair and also keeps the dealers on the ball. The same situation applies to the online Forex world. Two prices are always on the screen. The lower price is the bid and is the price that we will get when we sell a contract of Forex. The higher price is the ask, or offer, and is the price you will pay when you buy a contract of Forex. I was always very afraid when Deutsche Bank would call me looking for a price on the mark. They were the largest dealer in the currency. They knew what the price was and had a huge inventory of marks. The only reason they would call me was to try to pick me off. They wanted to see if I was quoting the price of the mark correctly. If I was on the money, they would simply say, "Nothing there," and hang up the phone. However, they would do a trade with me if I was quoting the price incorrectly. For example, let's say that the market was 63 to 65. But they would sell to me if I quoted them 64 to 66. They would sell to me at 64 knowing that they could buy at 63 from their clients, thus making a pip on the trade. I was always very proud of the fact that they would always say, "Nothing there," whenever they would call me. That meant that I had quoted the market correctly. I would have most certainly lost money if they had done a trade with me. They knew that market far better than I did. There are a lot of different currencies in the world to trade, but the volume is concentrated in just a few. The most popular are, with nickname and official name, Euro versus Dollar, Euro, EUR, USD. Dollar versus Yen, Yen, USD, JPY. British Pound versus Dollar, Pound, Cable, or Sterling, GBP, USD. Dollar versus Swiss franc, Swissy, USD, CHF. Dollar versus Canadian dollar, Loonie or Canuck buck, CAD, USD. Dollar versus Australian dollar, Oz or Aussie, AUD, USD. Euro versus Yen, EUR, JPY. Euro versus Pound, EUR, GBP. Euro versus Swiss franc, EUR, CHF. You'll notice that every currency is a pair. You are always long one side of the pair versus being short the other side of the pair. You can be long or short either side. When you buy EUR, USD, you are actually buying the euro while simultaneously selling short the dollar. When you short the EUR, USD, you are actually selling short the euro while simultaneously buying the dollar. That is the convention. Let's take a look at the Swissy or the USD, CHF as an example. First, what does CHF stand for? It stands for Confederation Helvetia Franc. They don't call it Switzerland in Switzerland, they call the country Helvetia. The currency unit is called the Swissy even though the pair starts out with a USD. The Swissy is the USD, CHF. Foreign exchange in the interbank world is usually traded in units of $1 million. The typical trade is for $5 million. The normal futures contract calls for delivery of 125,000 of whatever is being traded. So the Swiss franc contract calls for delivery of 125,000 Swiss francs. The retail Forex world has a standard contract worth $100,000 of whatever is being traded. So trading the euro would mean that you would be trading $100,000 worth of euros. Of course, the number of euros that you would be trading would change based on the current price of the euro. There are now many contracts in the online Forex world where each contract is worth $10,000 of the underlying instrument. In fact, there are now micro contracts of $1,000 of the underlying instrument. The usual minimum unit that a pair can trade is called a pip. You can find out the value of a pip by multiplying the pip by the contract size that you are trading. For example, suppose that you are trading a standard online contract of euro. That would be $100,000 worth of euro. The euro is quoted like 1.5123. One figure to the left of the decimal place and 4 to the right, although there are now online brokers who quote in tenths of pips. So take the rule of thumb that the pip is the fifth figure from the left, the exception being yen when it is quoted under 100.00. The value of a pip for a standard online contract would be 0.0001 times $100,000, or $10. The value of a pip actually changes during the day as the value of the underlying instrument changes. In addition, some brokers may change the contract size less often. It is always best to double-check with each broker. In the futures world, pips are called ticks and are always worth $12.50. This is because the futures contracts are standardized at 125,000 francs, euros, or whatever. The only exception is the pound, for which the contract is 62,500 pounds and each tick is worth $6.25. The standard unit of trading in the interbank market is $5 million, while in the retail Forex market it is only $100,000. Does this mean that banks must come up with $5 million and we have to come up with $100,000 every time we want to do a trade? Thankfully, no. There is no margin or good faith deposit in the interbank market. Instead, banks do deals with each other simply on credit. A bank will have its credit officers examine the credit of the other potential trading banks. The credit officer might say that the Forex department can have a total exposure of up to $100 million. The Forex desk could then do one big deal worth $100 million or perhaps 10 different deals of $10 million each. The total, however, can't be over $100 million. The risk in the Forex world is not strictly a credit risk since there is no credit being extended. There is just a delivery risk. Consider this scenario. We have just bought €5 million yen from Widget Bank, which means that we must deliver €5 million worth of yen to them and they must deliver €5 million to us. The risk in this transaction is called delivery risk because the other side of the trade may fail to deliver, in this case €5 million. Forex trades are settled within 1 day, so the delivery risk is a 1-day risk. But let's say that we are in that trade for 10 days. In the interbank world, the initial trade gets rolled over every day as if it were a new trade. The delivery risk is eliminated from the previous day, but the very same delivery risk comes into play until the very last day when everything is reversed and there is no risk. It is very different in the online Forex and futures worlds. Here, we must post a margin deposit every time we do a trade. Although it is termed margin, it is different from margin in the stock world. In stocks, margin is a form of lending that uses stock as collateral. Interest must be paid on the balance owed to the broker. Margin in the Forex world is simply a good faith deposit. You can even sometimes earn interest on it. The broker will freeze a certain amount of money for each contract you enter into. They will not allow you to put on a trade if there is not enough margin in the account. For example, the margin to enter a long EUR/USD trade in our online trading account is $500 for a standard contract. We have $1,000 in our account. The broker will allow us to enter no more than 2 contracts. However, we have to have that $1,000 margin for those 2 accounts at all times. If the position starts to lose money, the broker has the right to liquidate the position. They do that to make sure that you always have enough money in your account in case a position goes against you. And, yes, they will liquidate your open positions in an instant if you go below the margin position in your account. The situation is similar in futures. Transaction costs. The biggest transaction cost in trading Forex is the bid-ask spread. The bid-ask spread is the difference between the bid price and the ask, or offer, price. For example, suppose that the market is 63 bid and 66 offered or asked. You will have to buy at 66 if you want to buy or sell at 63 if you want to sell. Let's assume that you buy at 66. For the interbank and futures trader, the price on the screen will show 66 and it will appear that you have a break-even trade. However, if you were to instantaneously try to sell it, you would sell it at 63 for a 3-pip loss. Online brokers will immediately show that you have a 3-pip loss because they will show the bid price as the last price, not the last price. No matter how it is presented, you will have an instant loss of 3 pips when you enter a trade with a 3-pip spread. Hopefully, the market will move in your direction right away and eliminate that bid-ask spread loss. But, obviously, it can also go the other direction. The point is that the bid-ask is an implicit cost in every transaction. The bid-ask spread can be anywhere from 1 pip to tens of pips. The more liquid the instrument, the narrower or tighter the bid-ask spread. So, generally, it is much cheaper to trade EUR/USD than GBP/AUD. The bid-ask could be 10 pips on the GBP/AUD at the same time the EUR/USD may only be 2 pips. Everybody pays the bid-ask spread unless you are a dealer, which essentially means that you are a large bank. In the case of the large bank dealers, they are the ones who are making the bid-ask spread, and that is a major profit center for the banks. They quote the bid-ask spread to the online brokers and implicitly into the futures market. They are willing to sell to us at the ask and willing to buy from us for the bid. They implicitly make that bid-ask spread as a profit. That compensates them for providing us with the ability to trade whenever we want to. Futures traders and sometimes interbank players must pay a commission. Futures traders must always pay a commission to their broker to execute their trade. Interbank traders will sometimes execute a trade through an interbank broker and will have to pay a pip or a half pip to the broker to execute that trade. Transaction costs become more important the shorter the time horizon of the trader. A person who is going to hold a position for months could care less about the cost of the bid-ask spread. A 3-pip spread over months is irrelevant. But 3 pips is highly important for a trader who is doing many trades throughout the day. Their profit objective may only be 20 pips. 3 pips is a significant hit on profitability. Remember, the trader has to implicitly pay the 3 pips when you both enter and exit a trade. Effectively, the day trader is paying 6 pips to make 20. It never stops. Technically, Forex trading begins Sunday morning in Tel Aviv and goes to Friday afternoon in New York. However, the Tel Aviv session is so small that it is usually ignored and trading starts on Monday morning in Wellington, New Zealand. Traditionally, the trading day begins in Wellington because it is the first trading center that opens. However, Wellington is a small trading center, so there is little trading. Trading really becomes more active when Sydney and Tokyo open. The London Forex Center is the center with the highest volume, so trading really takes off when it opens. New York opens when London is at lunch and is the center with the second highest volume of trading. The period with the highest volume is during the afternoon in London and the morning of New York. London then closes, leaving New York as the final trading center open for the day. There is decent volume in the New York afternoon except, perhaps, on Friday afternoon. The slowest time of the day is between the time New York closes and Wellington opens. The cycle never ends. My biggest losing trade. There are 3 main orders you can place in the Forex market, though online brokers can be more creative. The first order is the market order. In this case, the order could be to buy 5 at market or sell 8 at market. The quantity changes with each order. As mentioned earlier, the market always has a bid price and an ask or offer price. A market order to buy is always filled at the ask and a market order to sell is always filled at the bid. The only exception is when the quantity to buy or sell is larger than the quantity on the bid or ask. For example, you want to sell 8 contracts at the market. The bid is 79, but there are only 5 bids at that price. There are 3 bids just below that at 78. So you would sell 5 at 79 and 3 at 78. A market order must be filled by the broker at the best bid or ask immediately. A limit order is an order to buy when the market goes lower or to sell the market when it rallies. Let's assume that the market is 38 bid and 39 ask. A limit order would be to buy the pair when it dips to a level below the current market. So, for example, you would put in an order to buy 2 contracts at 33 limit. Your order will be filled when the market trades or is offered at 33. You will use the limit order whenever you want to buy a dip in the market or sell a rally. The stop order is the order I use more than any other. A stop order is used when you want to buy something at a price higher than the current market or wish to sell a pair at a price below the current market price. Consider this: the market is 38 bid and 39 ask. A stop order would be used to buy the pair when it rallies up to 45. So, for example, an order to buy 2 contracts at 45 stop would be placed. It becomes a market order when the market trades or is bid at 45. The order will be filled at whatever the best offer is at that time. Use a stop order when you want to buy a pair at a price higher than the current price. A stop order is often called a stop-loss order because the most common use of a stop order is to exit a position. For example, a limit order can be used to buy EUR/USD at 135.60. To exit the trade, you should trade down to 135.30. You would enter an order to sell at 125.30 stop. This would become a market order to sell if the market trades or is offered at 135.30. However, I use stop orders almost exclusively. A lot of people think I'm crazy because they don't understand why I would want to pay a high price for something using a stop order instead of a lower price using a limit price. Buy low, sell high, they say to me. The first problem with limit orders is that you almost always have a losing trade immediately. For example, you have an order to buy a pair at 85 limit. You can only be filled if the market trades at 85 or is offered at 85. In the real world, the price will drop below the 85 limit price in order to get filled. The next pip after you have been filled will be 84 and, most likely, the price will move even lower before finding support. That means that you will be sitting on a losing trade right away. The more important problem with limit orders is that they break one of the basic tenets of profitable Forex trading: don't fight the market. Buying using a limit order is buying when the market is dropping. You don't want to buy when the market is dropping. The market is telling you that the situation is bearish because it is dropping in price. I never want to go against the market. It is bigger, faster, smarter, and better looking than I am. We will always lose the battle if we fight the market. Entering on a stop order creates a very different dynamic. You are nearly always in a profit position immediately. After all, you can be filled on a stop order until the market is trading at or higher than your stop order. The short-term momentum of the market will nearly always push the price beyond your entry price by at least a little bit. I'll take that profit edge any day. More important, using entry stop orders ensures that we are in tune with the market. We are only buying when the market is bullish and only selling when the market is bearish. This means that we have the wind to our back, not to our face. We are in sync with the market and, therefore, have the power of the market behind us. It may not stay there long, but it is always better to at least be in tune with the market for at least the beginning of any trade. The only time to use limit orders is when there is a liquidity problem with buying on a stop. I would have to use limit orders to buy when I traded for institutions because the size of my stop order would cause the market to go sky high. I need to be buying when others are selling, or else selling when others are buying so that I wouldn't affect the market. Fortunately, we retail traders don't have to worry about this. I was heading up a derivatives trading desk in the late 1980s. One of the derivatives we dealt and traded was options on Forex. We had a book of derivatives and then used a large quantity of Forex to hedge the risk. There was a big economic release coming up that day. I was using Forex futures to hedge my position. In particular, I was short the Swiss franc in large quantity and other currencies in lesser quantities. I was short hundreds of contracts. Bingo! The number was released and the market skyrocketed. I ended up having my protective stop filled about 150 ticks or pips above where my stop had been placed. There was a complete vacuum of orders above the market. The brokers couldn't fill my orders until 150 pips above my stop. The other interesting thing is that the cash market peaked about 100 pips under the futures market. In other words, there was much more liquidity in the cash market than in the futures market. I got hammered. I lost about $450,000 in less than 10 seconds. I should have lost about $150,000 because I had the wrong trade, but the incredibly bad fill cost me another $300,000. It seemed like the longest walk in my life as I trudged through the trading room to report my loss to my boss, the treasurer of the bank. In this case, the price jumped over the stop order, leaving me with a fill 100 pips beyond the stop order. That can happen with stop orders. That was a rare circumstance, but it can happen. It is fairly common to have a stop order filled a pip or two away from the stop level in your order. Just get used to it. I actually don't mind getting filled a little off my price because it shows that the market is moving so powerfully that there is a shortage of orders on the other side of my trade. I like that imbalance. I don't like it when I get a bad fill on a protective stop order. I want to get out at my price when I use a stop to protect an open position. On the other hand, I feel fortunate to get out, even with a bad fill, when the market gaps down beyond my stop because that means that there is so much pressure that there is no buying in the market. I definitely don't want to be long in that kind of a market. Note that this kind of situation never occurs with a limit order. You will always be filled at your limit price. Of course, you may be in deep trouble if that happens. Let's say you want to buy at 50 when the market is at 60. A big news item comes out and the market drops precipitously. You will be filled at 50, but the next print of the price may not be until 30. Basically, you were filled at a price that was way above the market. A market order will always be filled when the market is moving dramatically. However, it may be far away from the price on the screen when you entered the order and you may be left chasing the market to get filled. The bottom line. Knowing the nitty-gritty of Forex trading is important when you want to make money in the market. Learn how to enter orders correctly and enhance your profits through understanding which orders will optimize your order. End of Chapter 1. Chapter 2. Trend Analysis. The basis for all technical analysis. In the late 1980s, I used to trade a lot of mechanical technical systems. I had fundamental regression models of just about every market you could think of. I worked all day just feeding my computer with data and then putting in orders based on the output. But I had an epiphany. Why was I working so hard? I went through all my systems and realized that many of them were so highly correlated that there was no point to them. I also applied the Pareto principle, which states that 80% of the profits will come from 20% of the methods. And, in fact, that was basically the truth. I could cut out 80% of my work but still make 80% of the profits. In the mid-1990s, I had the opportunity to interview Peter Brandt. Peter was running a futures newsletter called The Factor, which was using strict McGee-Edwards chart analysis. He was a purist in using classical chart analysis. One of the things he said to me was that there are only about 8 to 12 megamarkets in the futures world each year. By megamarket, he meant a market that created at least $5,000 in profit and usually much more. That $5,000 in profit was the amount of money that would be made by holding a position for the length of the total move. I looked at futures charts going back many years and he was basically right. He then went on to say that his job as a position trader was to capture only those mega moves. His ideal trading year was if he caught only those trades. He felt the ideal year would only have 8 to 12 trades. Every other trade was not worth the risk. That might be an extreme view, but there is some truth to his concept. So I decided to strip my trading down to the bare essentials. I wanted to really get to the heart of trading. No BS, just rock-bottom truth. In fact, I wanted to strip things down so low that what I would come up with would sound like child's play. The basic truth of trading is that we must be long when the market is bullish, be short when it is bearish, and stand aside when it is neutral. Simple, yes? Let me say it again. Be long when bullish, be short when bearish, and stand aside the rest of the time. Easy to say, but is it easy to do? Yes. What is a trend? Turns out that there is a classic definition of a bull or bear market. A bull market is any market that is making higher highs and higher lows. A bear market is any market that is making lower highs and lower lows. A neutral market is any other condition. Once again, this is very simple. However, it is simple only if we agree on what a high or low is. And that has traditionally been a subjective decision. First, let's make a definition. The highs and lows that we are looking for will be called swing highs and swing lows. That will clear up some confusion with the highs and lows on each daily bar. Let's take a look at a chart and see where the swing highs and swing lows are. See Figure 2.1. I've circled a number of swing highs and lows on this chart during the period August through November. In this chart, you and I likely agreed on where the swing highs and lows were. We intuitively agreed. We didn't have a rule that said what constituted a high or low because, as humans, we can intuitively agree. But what if we disagree? What if you pick one high and I don't agree? What about the high 5 bars before the end of August? We skipped over those because we agreed that they were not important or significant. So the real key is to understand which swing highs are significant. We intuitively skipped over the insignificant highs and lows. But there may come a time when we may disagree on the significance of a given high or low. It would be better to have an objective way to determine the significance. My friend Tom DeMark is perhaps the most innovative technical analyst in history. He has probably added more and better technical indicators than anyone in history. One of his innovations is the idea of creating objective standards for what was traditionally considered subjective. For example, how do you label Elliott waves? More germane to this discussion, what highs should be used to create a downward sloping trendline? His objective criteria eliminates the subjectivity that is often found in such types of technical analysis as Elliott wave and classical chart analysis. No longer will you and I disagree about the proper slope of a trendline or the wave count. First, let me clarify some terms. The words high and low have two meanings. They can refer to the high or low of a given day's bar or candle, or the high or low point of a move over several or more days. Let's call this last meaning swing high and swing low. So the highs and lows on the chart that I circled are swing high and swing lows. Basically, DeMark showed that certain swing highs and swing lows are significant and other swing highs and swing lows are insignificant. The way he did it was ingenious. I think we can agree that the high in the middle of April is more important than the highs in the middle of October. We can see that very clearly on the chart. DeMark created a method for determining how significant a swing high or swing low is. The following is my interpretation of what I learned from him. Give him the credit for the initial genius and I'll take the blame for screwing it up. The basic idea is to identify every swing high with an objective rating system. The high in mid-August is the most important high on the chart because it is the highest high on the chart. The lows made in December and January are the two most important lows because they are the lowest lows on the chart. Major highs and lows show up as major highs and lows because they are the most extreme. DeMark's rating system is simple. Choose a swing high or swing low in Figure 2.1. For example, let's look at the first circled high on the chart from August. Now, look at the bar after this one and all the bars to the left of it. To be defined as a swing high, there must be one bar to the right that has a lower high than the day we are looking at and at least one bar to the left of it with a high lower than the high on the day we are looking at. That simple test defines a swing high. Reverse everything for a swing low. We have objectively defined every swing high. The circled bar at the high in August is a swing high, but the bar to the left is not. Note that it has a bar to the left with a lower high, but the bar to the right, the circled bar, has a high that is higher than the bar's high. So it is not a swing high. The bar to the right of the circled bar is also not a swing high because it has a lower bar to the right, but the circled bar has a higher high than the bar that we are looking at. The next step in the analysis is to rank the swing highs and lows. We do this by simply counting the number of bars to the left of the bar in question. Let's do this with the highest bar in August. We know that it is a swing high because it has at least one bar on either side of it with a lower high. However, there are 41 bars to the left of it with a high on the bar that is lower than the high on the circled bar. I would call that a 41-bar swing high because there are 41 lower highs to the left of it. There might be even more than that, but we got to the edge of the chart. Let's now look at the next circled bar to the right of the one we just looked at in Figure 2.1. That would be a low 4 days after that major 41-bar high. Once again, let's count bars. We know that there is 1 to the right and 10 bars to the left before we run into a bar that has a lower low. I'd call that a 10-bar low. You can go through all the highs and lows on the whole chart, rating them by how many bars they have to the left. It is clear that we intuitively rank bars with higher numbers as being more significant than bars with fewer numbers. This then leads to the concept that we can now use objectivity when describing chart patterns. For example, we can now agree that we will only draw up trend lines that connect 5 bars or higher lows. Looking at the chart, identify all the 5-bar lows and draw a trend line connecting the 2 most recent 5-bar lows. We will never disagree about where to draw the trend line because we have agreed that 5-bar lows are significant. Which leads to the next step in our journey. What bar level is significant? What bar level should we be focusing on to eliminate little random blip movements and keep us focused on what is really important? My experience is that 3-bar highs and lows are significant and that 2 and 1-bar highs and lows are not. Of course, there can be exceptions, but that is a strong general rule. Markets can often retrace against the trend for a day or two, but rarely will they move 3 days without it meaning something. To check this, look back at figure 2.1 and look for 3 bar highs and lows for trend analysis. I find that this bar level keeps me in the trend and avoids getting stopped out on random little blips. Let me digress for one moment. Every technique I teach has a stop loss attached to it. Most techniques taught in other books have stops attached to them. For me, I want every stop loss technique to have 2 attributes. First, the stop should only be triggered when something significant happens. I don't want to be stopped out on some little squirrely move in the market. Or perhaps just one big trade moves the market. I only want to exit a trade on a significant move. Second, I only want to be stopped out when I know that I am wrong. As long as there is no evidence that my original thesis is wrong, I must stay with the trade. I'll let a trade go against me a little when that movement is insignificant and does not invalidate my original trade idea. The ranking of swing highs and lows allows us to measure how significant a move is, thereby satisfying condition number 1. We will not be stopped out on trivial moves, but only moves that have some power behind them. Later in the chapter, I'll show you how this ranking allows us to satisfy condition number 2. From now on, I'm going to focus only on significant swing highs and lows, previously defined as 3 bar highs or lows. We're going to ignore all swing highs and lows that are 2 bar highs or lows. Let's take a look at figure 2.2. This chart shows the same currency pair over basically the same time frame, but I have changed the circles from what I intuitively identified as significant swing highs and lows to what I have now objectively defined as 3 bar high and lows. Note that there are not too many changes. The chart is roughly the same. However, now the significant highs and lows are objectively defined. Using our agreed upon definitions, our significant highs and lows would be the same. How to profitably trade bull and bear markets. Now that we agree on what the trend is in the market, we can go to the next step. Remember that a bull market is defined as a market that is making higher highs and higher lows. A bear market is a market that is making lower highs and lower lows. A neutral market is defined as any other condition. The highs and lows can come in any order. So, we could make 2 highs followed by 2 lows. Generally, however, we oscillate between highs and lows such that we make a high, a low, a high, and then a final low. But remember, it doesn't matter in what order the highs and lows occur. At the top of the chart in figure 2.3, look at the high in August. I've labeled the first 4 highs and lows. Note that in this case, the second high is lower than the first high. We can say that we are making lower highs. Also note that the second swing low is lower than the first low. Thus, we can say that we are making lower lows. This is the definition of a bear market. My concept is very simple but powerful. We must always be long in bull markets, be short in bear markets, and stand aside in all other markets. This is the basis for the most profitable technical analysis. We only need to look at the 2 most recent highs and 2 most recent lows to determine if it is a bull, bear, or neutral market. The analysis is updated every time a market makes a new significant swing high or low. That new swing high or low is added to our analysis. Usually, that new high or low simply confirms the current analysis, but sometimes it changes the trend. The 5th circle on the chart is a lower low than the previous low, so it merely confirms what is already a bear market. But look at the 6th circle. It is a higher low. So, at that point in time, the market is making lower highs but higher lows. So, it's a neutral market, right? The market then breaks lower and the next circle is a new lower low and the bear market is back in place. How to trade the trend. Once you understand significant swing highs or lows, trading the markets becomes easy. Go long when the market turns into a bull market, go short when the market turns into a bear market, and stand aside when the market is in any other condition. Let's take a look at some examples. In figure 2.4, start at the top swing high in August. That is our first swing high. It is then followed by a swing low and then a swing high. Note that I have drawn a horizontal line at the low of the first swing low. Our rule is to go short when the market breaks that horizontal line at the low of the first swing low. I've put an arrow pointing down on the day that we go short. We go short the moment the market drops below the low of the first swing low. I don't have to wait until the second swing low is in place to go short. Note that I am getting short before the second swing low is in place because I know that we will definitely be putting in a lower low in the future. I don't know when, but it will happen. There is no possible way that we won't put in a new lower swing low after we break that first low. In this case, the lower low that confirms that we are in a bear market actually occurs on the day the market breaks down through the first swing low. In other words, I can put in a sell short order under the first swing low as soon as I have a confirmed lower high. At the second high, I have conformed half of the definition of a bear market, lower highs. Now all I need to get short is to wait for a break of the first swing low to confirm that we will be making a lower low, again confirming a bear market. Once again, I don't need to wait until the lower low occurs to get short. I just need to know that it will be coming. And that knowledge comes as soon as I break the first swing low. The stop on short positions is the most recent 3-bar high. The protective stop on long positions is always the most recent significant swing low. I get to move the stop up whenever I am long and we make a new higher low. I get to move the stop down whenever I am short and we make a new lower high. So, in this case, we go short on a break of the first swing low and place a protective stop loss just above the most recent swing high, which, in this case, is the second high on the chart. The market then sells off and we are off to a good start on our short position. However, the fourth swing low turns out to be a higher low, as you can see in figure 2.5. I've marked it as a higher low. Now, we didn't know that low was a higher low until the close of the next day. We need to see that extra day to let us know that day was a swing low. So we now see at the end of the day after the swing low that the swing low was, indeed, a swing low. We look back at the two most recent highs and see that the market is still making lower highs, but we are now making higher lows. That is one of the definitions of a neutral market, and our rule is that we must be on the sidelines whenever there is a neutral market. We exit the position on the open the next day for a modest profit. We are now flat on the open of the day after the swing low. We now look at the chart and notice that a break to below the most recent swing low would turn the market bearish. We put in a sell order to sell on a break of the most recent swing low. This move occurs later that day and is marked in the chart with a downward pointing arrow. We don't know when we will make a new swing low, but we do know that it is guaranteed to occur, so we go short. Our protective stop on this trade is way above the current market at the most recent swing high, which is the second high on the chart and was also our protective stop on the first trade. Remember, we don't need to actually see a lower low, we just have to know that one is guaranteed to come. And that guarantee comes when we break the most recent swing low. We then make a lower swing low the following day and a lower swing high 4 days after getting short. We now get to lower our protective stop to just above the new lower swing high. 4 days later, we make an even lower swing high, so we lower our protective stop to just above that level. The market then collapses, putting us into a nice profit position. Notice that we don't lower our stop at all until we finally make a lower high in mid-October. We go over 2 weeks with the old stop. This is one of the interesting features that you will have to deal with as a trader. Remember that we want all stops to fulfill 2 conditions. First, we don't get stopped out on some random move, and second, we don't want to exit a position until after we know we are wrong. Trend analysis often gives the trader lots of room to work so that he or she is only stopped out when those 2 conditions are in place. It can be psychologically difficult to watch a market drop dramatically, producing a big profit, yet the stop is not moved closer in the hopes that a bigger profit is to come. It is better to sometimes sit back and let the market run. Here's what legendary trader Jesse Livermore said in Reminiscences of a Stock Operator, John Wiley & Sons, Inc., 1994. And right here let me say one thing. After spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this. It never was my thinking that made the big money for me. It always was my sitting. Got that? My sitting tight. It is no trick at all to be right on the market. You always find lots of early bulls in bull markets and early bears in bear markets. I've known many men who were right at exactly the right time, and began buying and selling stocks when prices were at the very level which should show the greatest profit. And their experience invariably matched mine. That is, they made no real money out of it. Men who can both be right and sit tight are uncommon. I found it one of the hardest things to learn. But it is only after a stock operator has firmly grasped this that he can make big money. It is literally true that millions come easier to a trader after he knows how to trade than hundreds did in the days of his ignorance. That's right. Sitting is how he made his money. The point here is that traders should stick with positions that are making money. Don't exit them prematurely. I'll talk more about this in a later chapter. Going back to figure 2.5, we see that the market continues to drop off a cliff to the circled swing low seen in late October. 2 sharp up days create a new lower swing high, and we get to lower our protective stop to that new swing high. We then get stopped out for a significant profit 5 days later. This sequence of swing highs and lows and the resulting trades gives you a clear idea of how to trade the trend in the market. It is technical analysis stripped down to the absolute essentials. Let me repeat the rules. Go long the moment the market moves into a pattern of higher highs and higher lows. Note that all 4 points don't have to exist to get long, but 3 of them do have to exist, and the 4th must be in the process of being formed. The reverse is true for bearish markets. Megaphones and pennants. There are 2 neutral market formations to look out for: megaphones and pennants. You want to be looking out for them because it is harder to see entry points when the market is in a neutral phase than when it is in a bull or bear phase. Also, it will save you time if you can identify a megaphone formation, because there is no entry possible with this formation, while it is very likely that you will be filled soon on entering the market when there is a pennant formation. A megaphone formation occurs when the market is making higher highs but lower lows. As a result, it looks like a megaphone if you draw a line connecting the highs and a line connecting the lows. Okay, it may look like a funny-shaped megaphone, but you get the idea. Take a look at the first swing high in November, shown in figure 2.5. We have just put in a new swing high that is higher than the previous swing high of a week earlier. Note that the 2 most recent swing lows are forming lower lows. In sum, we are making higher highs and lower lows and thus forming a megaphone formation. This means that there is no possible way to enter the market. We can't be a buyer or a seller. We can't buy if we make a new high because it is still a neutral market, because we are still making lower lows. We can't sell if we make a new low because it is still a neutral market, because we are still making higher highs. Don't waste time looking at this pair if there is a megaphone formation, because there is no way that you can get long or short. Go look at something else. Don't waste time here. On the other hand, a pennant formation is an excellent sign that a new trade is imminent. You should be able to get long or short quickly. Let's look at an example. In figure 2.5, start at the beginning of October and look to the left or back in time. Note that the 2 most recent highs are making lower highs. Note that the 2 most recent lows are making higher lows. The most recent low is just barely higher than the previous low. In this case, we can put in 2 orders. 1. Buy on a break of the most recent high, and 2. Sell on a breakdown below the most recent low. It is likely that one of these 2 orders will be filled soon, since a pennant formation is a formation where prices are winding up into a narrower and narrower range. It usually doesn't take long for the market to break out of the range and start to trend in one direction or the other. A megaphone formation occurs when there is no direction in the market and a lot of volatility. I don't want to trade in a market like this. There is too much risk, due to the lack of direction yet high volatility. A pennant formation occurs when the market comes into balance. Neither the bulls nor the bears have enough power to get the market to trend. That means that prices wind into a narrower and narrower range. At some point, Either the bulls or the bears will gain enough strength to push the market out of the range and into a trend. We will be ready for this breakout no matter what direction it occurs. We will have orders to buy on a break of the most recent high and orders to sell on a break of the most recent low. Notice also that the stop on a pennant formation is likely to be fairly close to the market. Keep an eye out for pennant formations. You are about to make a trade. Average directional index. I think that I have the greatest mentoring clients. I provide a mentoring service through the Investment Mentoring Institute. One of the great joys is that I get to learn a lot. My students are diligent about making money, so they intensely investigate the markets. One of them came up with an improvement on what I was teaching, and I want to share it with you. First, let me tell you about Average Directional Index, ADX. Here is how StockCharts.com, recommended for stock traders, describes ADX. J. Wells Wilder developed the Average Directional Index, ADX, to evaluate the strength of a current trend, be it up or down. It's important to determine whether the market is trending or trading, moving sideways, because certain indicators give more useful results depending on the market doing one or the other. The ADX is an oscillator that fluctuates between 0 and 100. Even though the scale is from 0 to 100, readings above 60 are relatively rare. Low readings, below 20, indicate a weak trend, and high readings, above 40, indicate a strong trend. The indicator does not grade the trend as bullish or bearish, but merely assesses the strength of the current trend. A reading above 40 can indicate a strong downtrend as well as a strong uptrend. ADX can also be used to identify potential changes in a market from trending to non-trending. When ADX begins to strengthen from below 20 and moves above 20, it is a sign that the trading range is ending and a trend is developing. J. Wells Wilder constructed ADX as an indicator that measured how strong a trend was no matter if it was up or down. The idea was not to identify the trend but the strength of whatever trend was in place. I won't go into how the index is constructed because there is plenty of information on the internet. I've tried many ways to use ADX, but virtually everything didn't work. All of the commonly explained ways to use it aren't successful. So here are the 2 ways that you can use ADX to enhance your profitability. ADX filters. This is the method my students shared with me. I was going along teaching trend analysis and channel breakouts, discussed in Chapter 3, and my student used ADX as a filter for the trades I was teaching him. He used ADX to identify which trend analysis and channel breakout trades to take and which ones to leave alone. Guess what? His filter improved the performance of the basic techniques. Stop and think about it. Trend analysis is a trend-following technique. We will make the most amount of money when the trends are strong and even lose money when the market is not trending. The filter takes trend analysis trades only when the ADX is higher than it was the prior day. Don't take the signal if the ADX is lower than the day before. It's that simple. What this does is to take out any trades that may occur while the market is not trending. A declining ADX means that the market is not trending, so the filter is taking us out of trades when the market is not trending. Only getting into trades when the ADX is climbing means that we are getting into markets that are already trending in our direction. This increases the potential size of the winning trade while also reducing the chances of a losing trade. This filter will sometimes eliminate a winning trade, but it eliminates far more losing trades to create a net improvement to the bottom line. The bishop. The second way that I use ADX is for a technique I call the bishop because it is almost infallible. This is an exit-only strategy. It is so simple that everyone always seems to make it more complicated than it is. Take a look at Figure 2.6. Across the bottom you will see the ADX indicator. Actually, there are 2 lines on the chart, but you should only look at the line that is more volatile. The other line is a smoothing of the first line. I look for the ADX line to be above 40 and then turn down. I then exit my trend following positions in all the techniques that I teach in this book, including trend analysis and channel breakouts. I never look at the ADX if it is below 40. I exit my positions on the first down day, no matter how small a downtick, in the ADX. Let me repeat, I don't care about any other pattern or level. I only care that ADX is above 40 and ticks lower. I'm only concerned with the day of the downtick after being above 40. I don't care about the day after the day it turns down. Don't complicate this indicator. Keep it simple. There is one bishop signal on this chart. Notice the peak in the ADX near the end of October. The ADX is above 40 and then turns down one bar after the lowest bar on the chart. We would then exit all of our trend following positions in trend analysis, channel breakout, and Coflex and go flat. This signal was a great signal at the time, as it got us out of the market the day after the low in the market at that time. We were able to take some great profits in the various method. We don't get many bishop signals, but they tend to be great when we do. I find that about half of the signals are astounding and get me out at or near the end of a trend. The others get me out at a good time, but I end up getting back in later. One of the issues of trend following is that you generally have to give back a fair portion of the profits when you finally exit the position. Trend following is designed to get you to take out the middle of the move of a big trend. The bishop is a major enhancement of classic trend following because it allows you to take profits at or near the end of the trend in many cases. Not all cases, but a good percentage of times. The bottom line. Trend analysis is a solid profitable performer. It is a method that will get you into bull and bear markets of intermediate length. It guarantees that you will make money while the market is trending strongly, but it will also enable you to profit from a short-term trend. End of Chapter 2. Chapter 3. Channel breakouts. The trend is your friend. Probably more money has been made using channel breakout techniques in Forex than with any other technique. This is a pretty strong statement. But you can look at the 10 largest CTAs or public Forex trading companies and you will see that virtually every one of them is using some form of channel breakouts. This incredible precept should make every trader stand up and pay very close attention. It should be a core technique for every Forex trader. The beginnings of channel breakouts. The first real description of channel breakouts came from investing pioneer Richard Donkian. Donkian was the creator of the first publicly traded futures fund in 1948. He was an innovator in the field of technical analysis. His ideas form the basis for some of the most successful traders of all time. He was the person who first coined the term trend following and was one of the most important technical analysts of all time. One of his most famous and successful ideas was his 4-week rule. He designed it for trading stocks and futures, but the concept works for Forex. The basic rules are incredibly simple to follow. You buy the currency pair when it makes a new 4-week high or sell when it makes a new 4-week low. If you get long, then you reverse and go short if it makes a new 4-week low. If you get short, then you reverse and go long if it makes a new 4-week high. That's it. Simple. Turns out that this simple system has been consistently profitable since he first wrote about it in the 1960s. However, there have been many enhancements by others to the basic rules outlined by Donkian. There has been a lot of research into channel breakouts in the intervening years. Channel breakouts became perhaps the most dominant form of trend following in the 1980s. Famous traders, such as Richard Dennis, became incredibly rich and famous using channel breakouts. Now, billions of dollars are being traded using channel breakouts. I think that the basic premise behind channel breakouts was that prices would drift sideways unless a new fundamental environment came into play. New fundamental data would cause the market to need to discount that new information and cause the price to move in one direction or another. This movement caused by a change in the fundamentals would trigger a buy or sell signal on the channel breakout. The channel breakout was not predicting a change in prices but was adept at identifying them. Another way to look at it was to consider what must be happening in a market to cause the price to make a new 1-month high. Something, we don't know what, must be happening that is significant in order to cause the price to move to a new 1-month high. Note that generally bigger fundamental factors are necessary to break longer channels. It is likely that something far more significant is happening when a pair makes a new 3-month high than if it makes a 3-day high. This is a critical concept. Generally, we can gauge the power of the move by the length of the breakout. It takes a bigger fundamental change in a market to make a new 52-week high than a new 5-day high. I pay much more attention to new 52-week highs than 5-day highs. Take note of this concept. I'm going to show you how to trade channel breakouts, including my own enhancements. What is a channel breakout? A channel breakout is simply a breakout of the high or low of a certain number of days in the past. For example, to find the entry and exit points for a 20-day channel breakout, you look back over the last 20 days of price and identify the highest price and the lowest price during that period of time. Those are your initial buy or sell points. You put in a buy order just above the 20-day high and a sell order just under the 20-day low. Let's assume you are not filled on the first day. On the next day, you go back 20 days and again identify the high and low for that period. Most days, the 20-day high and low will not change. You do this every day to define a new 20-day high price and a 20-day low price. Every day, you would put in a new buy order just above the new 20-day high and a sell order just below the new 20-day low. Eventually, you will be filled on either the long or the short side. Your initial stop is the entry order on the other side of the channel. For example, you are trading Euro USD and the 20-day high is 1.50 and the 20-day low is 1.40. I like to buy 3 pips above the breakout level. So, in this case, you enter an order to buy at 1.5003 and an order to sell at 1.3997. The price trades up to 1.5003 and you are filled on the long side. Your original stop loss is 1.3997, which means that the original sell order now acts as your stop loss. You don't have to do anything. Just leave that original sell order with your broker. Once you are filled on the long side, in this example, place a new order to sell at 1.3997. Now you will have 2 orders to sell at 1.3997. You need to do this because the first order there will exit the long position, but you need the second order to get you short. Classic channel breakouts are always in the market, either long or short. Let's look at figure 3.1 to bring this to life. I've selected this chart because it shows both trending and non-trending markets. It shows both typical winning and losing trades. The chart shows the British pound from March through November. I've put a 20-day channel on the chart. Remember, the 20-day channel on any given day is simply the highest and lowest price for the previous 20 days. At the end of every day, you will put in orders to buy slightly above the 20-day high and sell slightly below the 20-day low. Early in April, the pound dropped below the 20-day low, thus triggering a sell signal getting us short on the pound. We already have in an order to buy above the 20-day high, but we add another similar order to make sure that we get long if the pound rises above the 20-day high. Remember, we are always in the market using the classic channel breakout technique. So, if the price traded up to above the 20-day high, we would get stopped out on our short position but also go long. That means that we need to have 2 buy orders above the 20-day high. The market continued down over the next week and our trade looked good. Note that our stop at the 20-day high doesn't change for almost 2 weeks. That's because the highest price for each of those days didn't change. However, in mid-May, the top line representing the 20-day high finally started to drift lower. You would lower the protective stop and the long buy order each time that the 20-day high moves lower. The pound then drifted sideways through the end of April but broke down again in early May. The price of the pound started to rally in mid-May. It rallied almost up to the top line of the channel but never surmounted it. The pound then dipped down to the 20-day low in mid-June. That dip was followed by a rally that eventually caused a break of the 20-day high line near the end of June. You would be stopped out of the previous short position and would also get long. You would have lost about 250 pips on the short position and be long with a stop at the 20-day low line. We get a few days of follow-through, but the market then turns lower into early July. The market then hits a new high in mid-July and we are thinking we are genius traders. We also are raising our stop just about every day during this time as the 20-day low line increases. However, the market then starts to drop and we get stopped out and go short very early in August. This trade loses us about 200 pips. The market then plunges at the beginning of September. The stop loss is starting to move lower but is still very high above the current price. We are up about 1,900 pips on a mark-to-market basis. But then a sharp rally starts in the early part of September that hits the top of the 20-day channel in the third week of September, where we are stopped out with a profit of about 1,000 pips and go long at the same time. That position would then be stopped out in the first week of October for a loss of about 1,200 pips, and we would also go short at the same time. We would still be short with an open profit of about 2,200 pips at the end of the chart. This technique would be called the 20-20 system because we use the 20-day high, low to enter the position and the 20-day high, low to exit the position. Note that the 20-20 is essentially Donchian's 4-week rule, 4WR, since there are 20 days in 4 weeks. We would have ended up being profitable during this period of time, but it would have been an aggravating profit. We'll make some enhancements to the system to improve it. I don't recommend using this system. I just wanted to show the concept of channel breakouts using the simple 4-week rule. The 20-20 system is profitable, but there are other superior methods you can use. Better channel breakouts. Over time, investors discovered that the simple 4WR could be enhanced. A big change was to make it not always in the market. The system could be sometimes in the market, but there would be times that it would not be in the market. In other words, the 4WR was always in the market. You were either long or short all the time. So the first enhancement was to create a system similar to the 4WR but was not always long or short. It could instead be long, short, or flat. The second enhancement was to change the length of the channels. It turns out that longer channels can work much better for timing entries. In the late 1980s, I started using what I called the 40/20ths. When there was a break of the 40-day high or low, we entered long and short positions. The 40/20ths was the same system as the 4WR, except that the time was twice as long. You could say that entries were made using an 8-week rule. However, the exits were on a break of the 20-day high or low, depending on whether you were long or short. This meant, for example, that you would enter long when the market made a new 40-day high and you would exit that trade when it made a new 20-day low. Note that you did not go short when the market made a new 20-day low, you only exited your existing long position. You would be flat the market if you got stopped out. This is different from the classic channel breakout. With the classic channel breakout, you are always in the market while the new method has you on the sidelines. This was a major breakthrough in channel trading. Often a market would be in a nice strong rally and then quickly dip to the bottom and get short on what was really just a retracement in a major bull market. The rally on the British pound chart, figure 3.1, in September is an excellent example. In hindsight, we wouldn't want to get long on that break to new highs. We would have preferred to stand aside. I'll show you how to avoid those dings later. I used the 40/20ths for many years. Studies and my own experience showed it to be a nicely profitable system. I later changed to a 55/20ths after the release of the Turtle system to the public. The Turtles were a group of traders trained by legendary traders Richard Dennis and William Eckhart. They were basically trend followers and their core techniques were channel breakouts. They had settled on 55/20ths parameters. The Turtles were some of the most profitable traders, so I was intrigued to find out that they were users of channel breakouts. In addition to using 55/20ths, they were also using the classic 4WR. I love to learn, particularly from great traders. Dennis and Eckhart certainly fit that description, having made hundreds of millions of dollars by the mid-1980s. It was amazing that they achieved that much success using the old-fashioned 4WR. But they had also found out that using a longer-term entry parameter combined with a shorter-term exit parameter was an improvement over the classic 4WR. They had also created other rules for trading, but this was the core upon which everything else was measured. I had not checked which parameters were best, so I tested whether the 55-day parameter was better than my 40-day parameter. It was. Actually, just about everything between 50 to 60 days had about the same results. So I enhanced my trading by switching to the parameters that the turtles were using. Basically, I was shifting from a 2-month breakout to almost a 3-month breakout. I was going to be trading less often, but presumably entering only when there was a monster move in place. To repeat, entries are made using 55 days, but exits are made with 20 days. Let's look at an example. Figure 3.2 is the same chart as shown in Figure 3.1, but now I've added a 55-day channel. If the 20 and the 55 channel high and or low are the same, then you will only see one line. An example of this is the month of July. The top channel for both the 20-day and 55-day high are exactly the same, so you only see one line. But note that there are two lines below the prices. The higher line is the 20-day low line and the bottom line is the 55. Let's follow the same process we did earlier, but this time add in the 55-day parameter. First, note that we do not get short in early April but wait until early May. This shows a couple of things. First, 55-day breakouts will occur far less often than 20-day breakouts. In this case, the market had to drop for another month to create a strong enough bear market to trigger the 55-day low. Second, this actually hurt us in this trade because we sold at a price lower than we would have using the 20-day low. On the other hand, I actually don't mind the lower price for the entry because it means that I didn't have my money tied up for about a month with the market going nowhere. I don't want to invest in things that are going sideways. It's a waste of time and attention. We get short then in early May and get stopped out when the market moves above the 20-day high near the end of June for a loss of about 450 pips. Now we are on the sidelines, not long. The market then moves sideways and then breaks the 55-day high and gets us long in the middle of July. That trade quickly fails and we are stopped out right at the beginning of August for about a 650 pip loss. A few days later, we get short when we break the 55-day low on August 8th. The market then collapses and we show a profit until the sharp rally stops us out near the end of September. We still make about a 750 pip profit. We get short again in early October and would be showing a nice profit as the chart ends. Note that this shift to 55 days eliminated the short position in early June. We lost a little more on the losing trades than when we used the 4WR, but we were able to eliminate one of the losing trades. We are probably a little bit more profitable by adding in this new, longer entry channel. Over the long run, we will be much more profitable. A lot of people ask me what will happen if these two parameters become very popular. Won't that degrade the performance? There is no question that a method can become too popular and the performance begins to degrade. But this technique is robust. First, few traders are looking at 55-day highs. Most traders are using short-term support and resistance to time their trades. They are looking at 10-day moving averages and the most recent high or low. Few are looking back over the last 55 days. Still, it is possible that the 55-day high or low could have occurred in the last 10 days, and that means that a lot of traders will be looking at that point to buy or sell, which will degrade performance slightly. I'm always concerned about dealers and other short-term traders moving a price to just above the 55-day high, triggering stops, and then having the market collapse. The breakout will have occurred due to short-term price manipulation rather than a significant change in the fundamentals. I'll tell you how we can counteract that next. The 55/20ths technique is so robust that you can use just about any parameter between 50 and 60. If you think that everyone is entering on 55-day highs and lows, then shift to 54 or 56. Heck, you can go all the way to 50 or 60-day highs or lows and it won't make any difference. The basic technique is catching some deep human action. Shifting the parameters slightly won't change the performance. In addition, 55/20ths are not necessarily the optimal parameters for each pair at all times. The best overall parameter is 55/20ths because it works the best for all pairs over the longest period of time. I've found that the use of 20 days for the exit works well for most pairs most of the time, so I don't fiddle with it. However, I have seen the optimal length of the entry channel range from about 30 to about 70. I've seen the optimal entry parameter change from year to year by half or double. The problem with constantly changing the entry parameter is that you will always be using the parameter that worked over the recent past, not the parameter that will work in the near future. Sure, a parameter that worked the best last month or year will likely be the parameter that will work the best in the coming month or year. But I don't like to fiddle with the parameters because it makes the method less accountable and effectively turns the trading method into a discretionary method. I'll talk more about this concept in Chapter 9 on the psychology of trading. Chasing varying parameters is generally a waste of time. Finding a strong and robust set of parameters that works is the key, and I've presented those parameters. The pros and cons of channel breakouts. The biggest argument in favor of channel breakouts is that they are extremely profitable. They are the core technique used by the most profitable traders. That alone should be enough to convince you to use this technique. I recognize that my job is to make money, not to be brilliant or creative or even right. It's to make money. So I want to use techniques that make money, and the channel breakout technique makes money. One of the key advantages of channel breakouts is that you are guaranteed to catch the big moves in the pair. The big money is made on the big moves, so a huge advantage of channel breakouts is that they participate in every big move. This advantage can't be underestimated. It is this attribute that drives great traders to use channel breakouts. You can't make serious money trading without making sure you are on board with the big moves. Yes, the method can get chopped up with a sideways market, but even here the method works well. Having to make a new 55-day high or low cuts down on the whipsaws. It usually takes a strong move in the market to make a new 55-day high or low. That provides some protection against any possible false breakout. But don't fear, I will discuss the ways to protect against serious losses using channel breakouts. The main disadvantage with the channel breakout technique is that the stop loss is a long way from the entry point. I haven't talked about risk management yet, see Chapter 7, but let me just say that the wider the stop, the smaller your position will be if you have a position at all. In other words, you can't take a normal size position because the risk is so high due to the distance of the entry price to the exit channel. Getting stopped out is a painful experience because of the distance between the entry and exit channels. So what we need to do is to enhance the rules of channel breakouts to improve performance and reduce risk. The bishop. My first enhancement is to use the bishop to trigger liquidation signals. Take a look at Figure 3.3. I have taken Figure 3.2 and added the average directional index, ADX, indicator at the bottom. As you can see, the bishop gave us two good signals. I've put the cursor on the first signal to make it easy to see. Note that we exit right near the low of the major move down and move to the sidelines just before the rally that caused the standard rules for channel breakouts to be stopped out. The standard rules state that we exit only when we hit the 20-day high. Adding the bishop actually allows us to exit, in this case, near the bottom of the major move down and before the significant rally in September. This timely exit adds about 1,000 pips to our profits for the year. Remember that the bishop is showing that the trend has ended. It triggers a buy signal, in this case just a couple of days before the actual low in the move. This is a huge enhancement to the profits for the year. The next signal is not as good. Figure 3.4 shows the next bishop exit signal near the end of the chart. We have exited smartly, but we would have been slightly better off if we had stayed in the trade. Not bad, but not good either. In any case, the net result of adding the bishop exit signal is a major improvement to profitability for the year. I think this is a good example because it has one big winner and one small loser, which is typical of the bishop. It will make some amazing calls that add to our bottom line, but then we'll have a signal that hurts us slightly. The net result is still a big winner. ADX filter. My next enhancement to the basic channel breakout is to add the ADX filter that I introduced in the previous chapter. Let's take a new look at the GBP USD chart in Figure 3.5. This figure shows the ADX across the bottom of the chart. It turns out that every one of the trading signals occurred while the ADX was rising. As a result, the ADX filter never eliminated any trades. In Figure 3.6, the chart has been moved to the right so that you can see the more recent price action. I've put the cursor on December 4th where the market breaks down. Also note the breakdown just at the end of December. The ADX was declining in both cases, so we would not have taken either of these trades. As the chart shows, there was no real follow-through on either of these trades. The ADX filter saved us from the sharp rally to the 20-day high where we would have been stopped out for a loss of over 800 pips. The ADX filter helped us dodge a bullet. The ADX filter would have gotten us out of the trade at the end of December as well. This would have saved us a little money because we would have stopped ourselves out due to a new technique I'm going to show you next. But I still wouldn't have minded not entering that trade anyway. The market moved sharply higher and I would have been suffering mightily for a couple of weeks until the market finally broke down in the middle of January. I would have preferred not to enter this trade and instead get in a little lower in the middle of January. Using an ADX filter means that we will be trading slightly less often because, by definition, some of the trades will be not entered because at least some of the time the ADX will be moving lower. Our profits, however, are greatly enhanced because we will usually eliminate taking on some losing trades. Rarely will we be eliminating a profitable trade. It's no big deal if we eliminate a winning trade because we will get in at a slightly lower price. Remember, if the market breaks through the 55-day high, low, and the ADX is declining, we will look to get in on the next breakout, which only requires one countertrend move. For example, we break to a new 55-day high but the ADX is declining. We don't take the trade. But the market follows through and moves higher. I just need one day with a lower close to set up a new potential 55-day high buy signal. We never want to put ourselves in a position where we don't catch the big move just because the ADX is moving lower. Any follow-through after a missed 55-day entry signal will likely lead the ADX to move higher, so any subsequent buy signals will be triggered. We might have missed the first few days of the move, but we won't miss the big part of the move. The principle of instant gratification. I believe that one of the key underlying principles of profitable trading is the principle of instant gratification. This means that we should show a profit from the very beginning of the trade. Think back to your most profitable trades. Weren't they profitable from the very beginning of the trade or just after that? I think that my losing trades were nearly always losers from the first day on, too. Basically, you can almost predict whether or not a trade will be profitable by the price action of the first couple of days. We must always find ways to make sure that we are profitable from the beginning of the trade. This principle is one of the reasons that I prefer to be a buyer on strength and seller on weakness. This sharply increases the chances that my trade will be profitable from the start. The flip side of this principle is that I don't like to hold positions that are losing money. I want to get out before they become bigger losers. I don't want to wait around to see if they turn into winners. I want to get out right away. Rejection rule. This leads me to the next enhancement to the classic channel breakout method, the rejection rule. This rule is designed to ensure that we are in sync with the principle of instant gratification. Markets break out of support and resistance all the time. Sometimes the market will follow through and we will have a winning trade. Other times the market will fail and fall back below the breakout level. The question is whether the breakout was a false breakout or a premature breakout. A false breakout is a breakout that simply fails and never shows any follow-through. A premature breakout is a breakout that initially fails but eventually succeeds. The bulls needed to build more power before they could overwhelm the bears. Breakouts cannot be predicted, but we want to protect ourselves against any sort of breakout that has no follow-through. I call this rule the rejection rule because markets will reject a price if the price is too high or low for current conditions. The price may break out above a 55-day high but then move back to below the breakout level. In this case, the market has rejected the new high. The bears are able to quickly mount a counterattack and reject the breakout. The bulls do not have enough strength to keep the market above the breakout level. Take a look at Figure 3.7, which focuses on just one short period of the previous figures. An arrow indicates the breakout that we want to view. The first part of the rejection rule is the 5-day condition. I want to see that the 55-day high has been flat or declining for at least 5 days prior to the breakout. Use the opposite for breakdowns. The 5-day condition ensures that we don't apply the rejection rule to markets that are running strongly up or down. We only want to use the rejection rule when the market is roughly sideways. We want to find all the reasons in the world to hang on to a position when the market is running. We want to look for reasons to bail out if the market is going sideways. So we only apply the rejection rule when the 5-day condition is in place. Figure 3.7 shows that the 5-day condition is in place. The 55-day channel has been flat for over 5 days when the breakout comes on July 15th, see arrow. The rejection rule is now in place. The rejection rule is simple. If a 5-day condition is in place, liquidate a 55-day buy signal if the price of the market closes below the initial breakout level on the day of the breakout or the next day. In other words, the price must close above the breakout level for the first 2 days of the trade or you will exit on the close. If you can't exit on the close for whatever reason, for example, if you have a job that doesn't allow you to watch the markets during the day, then exit as soon as possible. Let's take another look at Figure 3.7. The market has broken above the 55-day high on the day highlighted with the arrow. In this case, the market opened below the 55-day high but broke through during the day. First, we want to check to see if the market closes above the breakout level of the 55-day high on this first day. In this case, the market closes above the 55-day high, so there is no rejection. However, the price closes below the breakout level on the second day of the trade, so we exit the trade immediately. We are still looking at the original 55-day breakout level that caused us to initiate the trade, not the new 55-day high created by the breakout day. Our loss in this trade is minuscule. We entered at a level just above 2.0000 and exited just slightly below that level. The loss is so small that it is hardly worth considering. But note that we would have been stopped out at about 1.9650 for a loss of about 350 pips if we were not using the rejection rule. The rejection rule saved us a lot of money, which is what it is designed to do. This trade aligns with the principle of instant gratification. The trade failed right away. It made a profit for 1 day, but it sold off a lot from the high of the day of the breakout. It only made money for 1 day, then failed. I have found throughout the years that it is better to eliminate trades that fail quickly rather than hope that they will eventually come back into profit. The rejection rule significantly improves the profitability of the classic channel breakout method because it eliminates a lot of trades that would otherwise be stopped out at the 20-day low for a much larger loss. My experience is that roughly half of the normal stop-outs are eliminated by the use of the rejection rule. This is a significant enhancement over the classic channel breakout. I'll talk about risk management in Chapter 7, but let me just point out that the risk per contract is greatly reduced by the rejection rule. Now, the risk on a trade will rarely be the 20-day low. Instead, it will be a risk that is unknown but likely close to the entry price. Note that it was only a few pips away from the entry price in the example in this chapter. The risk will usually be greater than our example, which is a common example. Think for a minute. You might normally allocate a certain amount of risk to each trade. Let's say you want to risk $1,000 on each trade. Let's further say that it will be a $1,000 loss if the 20-day low is hit. The rejection rule will kick in before the 20-day low in most cases. That is the result of the principle of instant gratification. Let's assume that you lose $200 every time you get stopped out on the rejection rule rather than the $1,000 that you lose if you hit the 20-day low. This means that you can either cut your risk by 80% or increase your profit 5-fold. Remember that this is just an estimate. This is a dramatic change to the risks and rewards that come from the channel breakout method. Let's explore this further. Let's assume that you want to cut risk by 80%. You will have a higher number of losing positions compared with the classic channel breakout. The rejection rule creates a stop that is close to the entry position. The closer a stop is to the current market, the more often it will be hit. It is not often that you will hit a stop that is the 20-day low. So you should expect to get stopped out fairly frequently. However, the average size of your losing trades will shrink dramatically. In our example, we will be stopped out more often, but our stop will limit our loss to only 1/5 of the loss of getting stopped out at the 20-day low. The net result of a higher number of losing trades with a sharply lower size of losing trades equals a big boost to our bottom line. Alternately, you could put on a position 5 times larger than you would normally. Okay, perhaps not that aggressive. But you could easily double or triple the size of your position and still take on less risk than you would using the normal channel breakout method. You would take the normal $1,000 risk on your position but receive double or triple the profits on winning trades. Let's look back at figure 3.7. Find the day before the actual breakout. The market was very close to the 55-day high, so we could put in an order to buy at 3 pips higher than the 55-day high. Where will the initial stop be? We know that we are going to put in a stop at the 20-day low, but we also know that we will be getting out at a much higher price should the rejection rule kick in. In this case, we need to determine where we would be stopped out should the rejection rule kick in. Of course, we never know where it will kick in, but we need to estimate this so that we can figure out the size of our upcoming positions. Let's say that we figure that we will be stopped out no lower than 1.9850 should the rejection rule be triggered. That is about 1/3 the dollar risk of actually trading down to the 20-day low. So, we can say that the dollar risk using the rejection rule is 1/3 of the risk of using the 20-day low. However, we will be stopped out on a slightly larger number of trades, so we need to scale the dollar risk higher to take into account the additional number of stop-outs. So, let's estimate that we will lose 50% less using the rejection rule than using the 20-day low. We must now decide whether we want to reduce our risk by 50% and only trade 1 contract or trade 2 contracts, which would boost the risk to 100% of the 20-day low but would double our profits should the trade work. In order to make this decision, the background environment must be taken into consideration. For example, is this trade in the direction of the long-term trend? What are the expected seasonal price tendencies? Do you have a fundamental bias? Are there any conflicting or supporting technical indicators? If the bias from these other factors is bearish, then you should probably just put on the 1 contract and cut your risk while maintaining the normal profits potential. If the bias is bullish from these other environmental factors, then you should probably double the size of the position, take the normal level of risk, but have double the profit potential. Once again, you now have the flexibility of either cutting risk and leaving the profit potential the same or keeping the risk the same and making more money. This is a major enhancement to the classic channel breakout. Adding the rejection rule adds significantly to the classic channel breakout. But there are 2 drawbacks. The first is that we don't really know where the risk is. We don't really know at what price the rejection rule will be triggered. This makes risk management a problem. Second, the rejection rule only covers the first 2 days we are in a trade. Do we really want to let our stop drop down to the 20-day low after the first 2 days in the trade? What if we were aggressive and bought a double-size position? Now the risk has ramped up dramatically and we may have a much larger position than we would want with a stop loss at the 20-day low. The last bar technique. The solution to this risk management problem is the last bar technique. I originally got this idea from ace trader Peter Brandt. I had the opportunity to interview him and read his book Trading Futures with Classical Chart Patterns, Advanced Trading Seminars, 2000. He used classical chart formations such as head and shoulders and trend lines. He used the chart patterns as outlined in McGee and Edwards' excellent book Technical Analysis of Stock Trends, Amicom, 1997. There is actually a chapter on trading futures in that book. The problem with McGee and Edwards is that they suggested that you enter, for example, a head and shoulders top on a break of the neckline with a stop above the right shoulder. This would be a very wide stop, and Brandt felt that proper risk management would mean that he would never be able to enter any trades. So what Brandt did was to put his stop, to carry on this example, above the high of the last bar in the formation. His concept was that the market had broken below support. It should be unlikely that the market would trade back up through the neckline and even go further and break the high of the last day in the formation. That would be two levels of resistance that should cap any rallies, particularly if the trade was going to be a winner. Brandt is using the principle of instant gratification here. Following Brandt's idea, I apply it to the channel breakout technique. Let's keep looking at our British pound example in figure 3.7. In this case, the market broke the 55-day high on July 15th. Note that the bar of the 15th is the last bar with any portion still under the 55-day level. We set our stop loss at the bottom of this bar. Let's assume for a moment that we are not using the rejection rule. That means that our initial stop loss in this trade would be the low of the bar of July 15th, or about 1.9940. We would have been stopped out 3 days later at that level for a loss of about 80 pips. No big deal. I will use the second to last bar if the last is barely below the breakout level or it gaps above the breakout level. We are trying to find the last bar or near last bar that defines where support will come in if the market sets back into the range. There is a certain level of discretion necessary to determine the best last bar. Most of the time, we can simply use the true last bar as our stop. We look for the bar that was the breakout bar. That should be the last bar 98% of the time. Only rarely are we going to look back one more bar to be the last bar. Tactics. There are 4 different exit strategies for the channel breakout method. Let's assume that we have bought the British pound. We will look at the rejection rule as our stop on the first 2 days we are in the trade. We will then shift to the last bar method after the first 2 days. We will look at the bishop starting from the first day and will keep it in mind every day we have the trade open. Finally, we will use the 20-day low once the 20-day low is higher than the low of the last bar. To repeat, first look at the rejection rule, then the last bar, then the 20-day low, in that order. We are looking at the bishop every day. You should be putting in both buy and sell orders every day if you have no position. Once you are in a position, you need to put in your protective stops depending on the method you are following. Taking profits. One of the key advantages of these enhancements is that it allows you to sometimes exit positions near the high of moves. I showed you how the bishop enabled us to exit with a huge profit in September. Let's look at some other trades. Refer back to figure 3.3. I had previously marked the bishop exit. That was a great exit and created a huge profit. We get short at the beginning of October. Notice that the rejection rule kicks in on the second day in the trade and we take a microscopic loss. But we enter short on the third day as we break down again. This trade has no 5-day condition, so there is no opportunity for the rejection rule to come into play. So we get short and use the last bar technique as our initial stop loss. We never get stopped out, so we shift from using the last bar to the 20-day high near the beginning of November when the 20-day high finally moves to below the level of the last bar. But before that, we get another breakdown in the middle of October. There is a 5-day condition in place, so there is a potential rejection rule. However, prices slam lower and the rejection rule is never triggered. But it does cause a new lower last bar, which could become our new stop loss, but I prefer to use the 20-day high. I prefer to use the 20-day high after I have a nice profit because it is best to give a profitable trade lots of room to make more money. You may want to move the stop on part of the position to the new last bar. Still, this should be a small percent of the total position. Use the 20-day high to make sure that you are maximizing the big money. So we remain short. But take a look in the lower right corner of the chart. Note that there is a 5-day condition in place on that breakdown 2 bars from the end of the chart. Notice that rejection rule kicks in and we exit the trade. At this point, We got short in early October near 1.7400 and exit near 1.4750 for a monster profit. More important, the rejection rule gets us out of the position on the absolute low bar on the chart. What perfect timing! There are few techniques that can get us out of positions so close to the absolute low of the move. So the rejection rule, and the last bar, will help to get us out of trades and take profits near the lowest or highest price in the move. This is a huge enhancement of the classic channel breakout. Basically, we have taken probably the most powerful profit-generating system in trading and added some strong enhancements that reduce the risk, enhance profitability, and allow us to often take profits near highs rather than waiting for the trend to reverse. The bottom line. If you only use one technique from this book, use the channel breakout method. But make sure that you use my enhancements, too. I believe that more money has been made using this technique in futures and Forex than any other technique. The technique can be used plain vanilla or easily enhanced using the methods discussed in this chapter. End of Chapter 3. Chapter 4. The Conqueror. This chapter discusses the Conqueror, which is a clever method that encourages some truly original thinking. I am a big fan of trading through multiple time frames. See Chapter 10 for more information on diversifying through time. This particular method looks at 3 different time frames before entering a trade. Most methods use the same method for entering and exiting trades. For example, you buy when the 20-day moving average crosses above the 50-day moving average and sell when the 20-day moving average crosses below the 50-day moving average. However, the Conqueror actually uses a different exit technique from the entry technique. This is rare in the world of trading. In previous chapters, we've covered ways to exit a trade that are different from the entry point. This uncommon approach leads to much higher profits than the basic method that most people use to trade. The Conqueror uses one method to enter and another method to exit. They are related to each other but are separate. In addition, the stop loss is adaptive. That is, it looks at current market conditions and adapts to those conditions to create the exit strategy. The beginnings of the Conqueror. The idea originated back in 1991 when Bruce Babcock created a system called the Currency Conquistador. Bruce was one of the pioneers of futures trading. He was the founder of Commodity Traders Consumer Report, CTCR, which is now web-only at www.ctcr.investors.net, which I bought from him in 1996 when he was diagnosed with cancer. He was the author of one of the most popular books on trading, Dow Jones' Irwin Guide to Trading Systems, and designed many profitable systems. Perhaps his greatest contribution to futures trading was a sense of integrity and cutting through the hype that fills the futures and Forex world. CTCR allowed no advertising, so Bruce could be totally honest in his reviews of products. Bruce fiddled with the Currency Conquistador for a few years and then released Currency Conquistador 2. This presented a more sensitive stop-loss method than the first version. At this point, ace researcher Nelson Freeberg enters the story. Nelson publishes an amazing newsletter called Formula Research, see Appendix, suggested reading for more information. Nelson develops trading methods and systems for trading most markets. He has a clever mind and has come up with some great systems. I highly recommend his publication. Nelson published an enhancement for the Conquistador at the end of 1994. One key enhancement was that the original Currency Conquistador was only for trading currencies. Nelson broadened the testing to other futures contracts and found that his modifications made it profitable for a broad list of futures. We are only looking at Forex in this book, but knowing that the method works on many more markets gives confidence that this is a strong method. Nelson also simplified the system, which is almost always a good thing. In this case, it was a good thing because Nelson's simplified systems outperformed the basic Babcock system. What is true range? Before I get into the mechanics of the system, let me first discuss true range as we will be using this concept in the calculation of the Conqueror. One of the advantages of the Forex market is that the opening price is basically the same as the closing price of the previous day. We close at one price and the opening price is simply the next tick. The only exception is the close on Friday going over to the open on Monday. Here, it is possible for a gap to be created by the change in price occurring over the weekend. In this case, we need to adjust for the potential gap in figuring out the true range on Monday. We will know what the actual range is by simply looking at the chart or a table and seeing what your chart service tells you what the range is. Good enough. The problem comes in when there is a gap between the range on Friday and the range on Monday. In this case, the reported range doesn't really represent the range of the day. Let's say that the price gap down and the high on Monday is below the low of Friday. The range that is reported is not reflective of what implicitly happened. Although no trading occurred between the high of Monday and the close of Friday, it can be said that the true high for Monday should have been the close of Friday. Here is how Nelson defined it in CTCR in 1995. To begin with, a day's true high is the higher of today's high or yesterday's close. The true low is the lower of today's low or yesterday's close. The true range is simply the true high minus the true low. The true range is designed to better measure the totality of price movement in cases where yesterday's close lies beyond today's price range. Table 4.1, reproduced from Commodity Trader's Consumer Report, shows the results of Nelson's final modification of the Conquistador. As you can see, the method is very profitable. In fact, here is what Nelson stated in his issue of Formula Research devoted to the Conquistador. The self-adjusting stop is perhaps the most innovative element in this versatile trading system. The wealth of applications inherent in the logic is a tribute to the analyst who designed it. We are in Bruce Babcock's debt for sharing currency Conquistador, which, in terms of sheer dollars gained, is the most profitable futures system Formula Research has published thus far. Commodity Trader's Consumer Report, 1991. Enhancing the Conquistador. Now I enter the story. I took Nelson's profitable modifications of the Conquistador and modified them. I've created two different versions. One is very long-term and the other is short-term. To differentiate the results from the excellent work of Bruce and Nelson, I changed the name to the Conqueror. Let's now take a look at the rules. First, we define several conditions. A positive number is bullish and a negative number is bearish. 1. Today's close minus the 10-day moving average, MA, of the close. 2. Today's 10-day MA minus the 10-day MA 10 days ago. 3. Today's close minus the close 40 days ago. Go long if all three conditions are positive. Go short if all three conditions are negative. Stand aside on any other condition. I'll get to the protective stop in a minute. Let's consider this entry situation. Basically, we are looking at three different time horizons. First, we are looking at the price action over the last 10 days when we look at condition 1. Condition 2 is really looking at the price action of the last 20 days. Finally, condition 3 is looking at the last 40 days. We do not go long or short until all three trends in the market are congruent. The concept of applying three different time frames is unusual in trading. I had kind of a "duh" moment when I first saw it because it is so obvious yet never really done. Basically, we are making sure that whatever trend is in place is powerful enough to turn all three directions bullish or bearish. A sideways market will not trigger the three conditions and we will stand aside in those situations, which is perfect. Only when the market really starts to move in one direction or another will the three trends line up and we will enter the market. Otherwise, one or more of the three conditions will be positive or negative and we will look for opportunities in other markets. It is, therefore, difficult to get a buy or sell signal from the Conqueror. Most of the time it sits out of the market. It stubbornly waits for the market to really get going in one direction or another before it jumps in with a long or short position. This is one of the most important features of the Conqueror. It sits out when the market is drifting sideways or has only a slight trend. This saves a lot of money in whipsaw losses. It is also a significant improvement over most trading methods. Let's take a look at an example. Let's pick up the action in the middle of September. The three conditions are mixed at that point. Let's follow the flow of the trade to see how it develops. I've marked 3 arrows in figure 4.1. The first arrow shows that condition 3 is negative. The close that day is below the close of the market 40 days previously. 3 days later, the price closes below the 10-day moving average, turning this condition negative. That's 2 conditions that are negative. We still can't go short because we need to have all 3 conditions negative before we can go short. Take a look at the chart. At this point, the market has had a down move from the upper left of the chart. There was a rally in mid-September. At this point, we don't know if this is the beginning of a new bull market or simply a counter-trend rally in the downtrend. The market should probably be considered as roughly neutral. At this point, we have 2 conditions negative and 1 positive. The conqueror sits back and waits until the trend is conclusively in one direction before entering. At this point, there are 2 negatives and 1 positive for only a net negative of 1. This is not conclusive enough for the conqueror. The one condition that is not cooperating is the 10-day MA because it is still not below itself 10 days previously. It is not until early October before the 10-day MA drops enough. At that point, as the third arrow indicates, the third condition turns negative. We go short on the close of trading on the day that the third condition triggers. If we don't know if the third condition has triggered until after the close of trading, then we go short on the open the following day. Okay, we are now short. All 3 conditions have been triggered. Where is our protective stop? Now it gets really interesting. We are going to use several different methods to determine the protective stop. The first stop is a simple money management stop. For a standard contract, place a stop that would be a $2,000 loss. In other words, figure out how many pips represents $2,000 and place a stop that many pips away from the entry price. Fortunately, this stop will rarely be triggered. The other forms of stop will be triggered far more often. Still, we want some disaster insurance in place. I've added another panel to the chart, see figure 4.2. The new lower panel shows the average true range, ATR, over the past 40 days. This is simply the 40-day average of the ATR. You can see that the ATR was about 0.024 on the day we went short. That is really 240 pips. You can also see that the market was becoming more volatile from August through November. The ATR was slowly moving higher during this period, showing that the average range for the day was increasing. In fact, it increased from about 150 pips per day to 350 pips per day. This is the point where we create the 2 different versions of the conqueror. Conqueror 1 will create a stop 2 times the ATR away from the current close, while Conqueror 2 will create a stop 12 times the ATR away from the current close. Let's look closer at the current situation as an example. Let's say that we get short at 1.7400. The ATR on that day is 0.0240, or 240 pips. Conqueror 1 will place a protective stop loss 480 pips above the lowest close in the move. On day 1, the lowest close will be the close of the entry day. Every time the market makes a new lower close, you would change the stop. In addition, you would also change the stop as the ATR changes. We started with an ATR of 240 pips, but it eventually gets up to about 350 pips in November. That means that we would start by adding 480 pips to the lowest close, but could be about 700 pips wide in November. I like this because it widens out the stop when the market is more volatile. That is perfect. The day after the entry bar, which is marked with the third arrow, closes slightly up. We would keep the ATR stop at the same level. However, the next day shows a drop and a lower close. We would lower the stop to 480 above the new lower close. And so on. Conqueror 2 uses the same idea, except the stop is 12 times the ATR, or about 2,880 pips above the lowest close. That is a significant distance from the market, so few traders will be able to trade it. I mention it here because it is a profitable method but challenging for anyone but the most highly capitalized to trade. I won't mention it again in this chapter. From now on, I'll only speak of the conqueror as being Conqueror 1. Adjusting the stop. So far, we have discussed two different stop-loss techniques: the initial $2,000 money management stop and the 2 times ATR stop. Now comes the really interesting part. We are going to adjust the ATR stop by how many conditions are in play. Remember that we went short when all 3 conditions were negative. Every time a factor changes sign, positive or negative, we will reduce the size of the ATR stop by 1/3. Let's work through an example. We originally put on the trade in figure 4.2 with a 480 pip stop. I'm going to ignore subsequent changes in the ATR in our calculations, but you shouldn't in the real world. Note that all 3 conditions remain negative until the downward pointing arrow in figure 4.3. At that point, the price closes just barely above the 10-day MA, which turns that condition positive. We take our 480 pip stop and deduct 1/3 of 480. 1/3 of 480 is 158 pips. We subtract 158 from 480, giving us a new trailing stop of 322. The lowest close occurs a couple of days before that at 1.7029. We place our new protective stop loss 322 pips above that at 1.7351. The price on that day does not stop us out, but there is a spike higher 2 days after the down arrow and we are stopped out for a 24 pip loss. We would not have been stopped out if we had continued with the original stop loss. It was wide enough to protect us from getting stopped out. Here, we got stopped out with a microscopic loss. But the market turns down the next day and the market closes below the 10-day MA, so all 3 conditions are negative again. We get short again on the close of that day at 1.7282. The ATR is exactly 250 on that day, so our first stop is 500 pips above the close at 1.7282. So we now have a stop 500 pips above the lowest close going forward until one or more of the conditions turn positive. The market trades down to a low close 4/5 of the way through October at 1.5537. On that day, we lower the protective stop to 1.603 less than 7, or 500 pips above the lowest close. We get stopped out the next day when the market moves up above 1.6057. We take a profit of over 1,200 pips. At this point, all 3 conditions are still negative. That means that we could actually go short right away. However, I prefer to get a confirmation signal before re-entering the short position. The best is that one of the conditions turns positive, then negative before we re-enter the market. That occurs 2 days later when the market closes just above the 10-day MA, turning that condition positive. The market closes back below the 10-day MA the next day, turning this condition back to negative and all 3 conditions negative. Time to short the market again. I won't carry the example along any further, but you can see that the next trade was also profitable. One of the keys is that the conqueror doesn't get involved in sideways markets. It sits patiently on the sidelines before getting involved. Also note that it moves the stop aggressively toward the current market price. Any significant retracement will stop out the conqueror. It's a nervous system in that it leaps out of positions quickly when they go against the trade. It's hard to get into a conqueror position but easy to get out. It is also clear that the conqueror loves a strong trend. It may get out quickly on a retracement but gets right back in if the 3 conditions reassert themselves. And they won't reassert themselves unless the 3 time frames are pointing in the same direction. The bottom line. The conqueror is a great technique that is being released to the general public in this book. This technique is based on systems designed by 2 of finest minds in this field, Bruce Babcock and Nelson Freeberg. That pedigree alone should make you want to try this method out. This one-of-a-kind technique requires that a number of factors come to fruition before a long or short position is entered. At the same time, the conqueror exits if the market hesitates just slightly. This means that the reward-to-risk ratio is superb. End of Chapter 4. Chapter 5. Stochastics. Stochastics are one of the most popular indicators. They are found on all the available chart services and software packages. They are a standard indicator in Forex trading. but nearly everyone uses them incorrectly. I'll be focusing on bullish trades, but everything also applies to the bearish trades. What are stochastics? Stochastics are a form of oscillator. An oscillator measures the rate of change of prices. The simplest oscillator takes the current price and subtracts the price some number of days ago. For example, suppose your USD closed today at 1.2050 and closed 10 days ago at 1.2000. The oscillator value would be 0.0050. This process would be repeated each day and plotted on a graph. The common wisdom is that oscillators will signal the turn in a market ahead of the actual turn in price because changes in momentum lead changes in the actual price. This idea follows the analogy of physics. The rate of change of an object will show decreasing momentum until the object actually changes direction. The big criticism of oscillators is that they sometimes give a trading signal, but the market is in such a strong trending mode that the signal is false. The common wisdom is that oscillators do well in non-trending markets and poorly in trending markets. The simpler the oscillator, the more sensitive it is to current market price action. For example, a simple oscillator based on the 10-day rate of change will be more sensitive to current price action than an oscillator based on the 30-day rate of change. Many analysts got beat up badly using the simple oscillators, so they tried to find ways to improve them. Wells-Wilder's Relative Strength Index, RSI, and stochastics are the two most popular and famous improvements on the basic oscillator. Larry Williams's %R is actually the same as stochastics except not smooth, and the scale is turned upside down. Stochastics are reasonably easy to calculate. There is a three-step process to calculate the two components of stochastics, %K and %D. First, calculate the raw stochastic number. K equals C minus L, divide by H minus L, time 100. Where C is the close of the last X number of days, H is the high for the last X number of days, and L is the low for the last X number of days. Typically, X is the last 14 days, though 9 days is also very popular. %K is a 3-day MA of K, and %D is a 3-day MA of %K. Fortunately, you won't need to know the math unless you want to fiddle with it to see if you can improve it. Virtually all chart services, quote systems, and software packages have stochastics built in. However, they sometimes fiddle with the parameters. I suggest using the parameters I just outlined. The software packages and quote systems often allow you to change the parameters. The one important question that must be addressed is the term of the stochastics. How many days will you use in your calculation? The classic answer is 14 days, which many people claim is about half of the normal cycle of Forex prices. Other people use 9 days, though I have never heard a justification for this number except that it is more sensitive than the usual 14 days. I have never seen any proof of the claim that the average price cycle is 28 days. Further, I have never seen any argument that you should, therefore, use a half cycle as your length in using stochastics. Nonetheless, fewer days in your calculations will lead to a more sensitive stochastic. Could the length of stochastics be optimized? By this I mean testing different parameters to find the most profitable one over a given test over past data. Yes, but first you have to determine how you are going to use them. Are you going to use them as an overbought, oversold indicator? Are you going to use them as a trend indicator? Each use of stochastics will likely lead to a different optimization. I won't get into the pros and cons of optimization here, so I suggest you read Bob Pardo's book on trading systems. See the appendix for more information. Unless otherwise stated, I will use 14 days as the length of the stochastics. Why? Well, I came up with all these profitable techniques when everything had to be done by hand, and 14-day stochastics were all we had to use when testing. In the meantime, I have seen that these techniques work, so I am loath to change them. I leave it to my super intelligent readers to optimize them. A second reason to use 14 days for the length is that readers can easily use the indicators because they are the most common in available software packages. There is no need to fiddle with your software package to figure out how to change the parameters. The techniques outlined in this chapter work similarly on both 9 and 14-day timeframes. This is an important suggestion that stochastics are a robust indicator. However, the main difference between the 9 and 14-day stochastics is that the 9-day is more sensitive and gives more indications or signals. A key consideration in determining which length to use is your particular trading style. A longer length will give fewer signals and later signals but will filter out some whipsaws. A shorter length will give more signals and earlier signals but will be whipsawed more often. Stochastics are essentially a measure of the close as related to the high and low. The stochastic measures the percent distance of the close to the range. Thus, a reading of 50% means that the close is halfway between the high and low. A reading of 75% means that the close was at the 75% level between the high and low. In other words, it was at the 75% level of the day's range or nearer to the high than the low. This means that you can only see a stochastic reading of 100% if a market closes on its high every day in the study. The underlying concept is that it is bullish if the market is tending to close in the upper half of the day's range and bearish if the converse is true. Stochastics are used to trade all time frames, including day trading. Obviously, the most popular time frame is daily, using daily bars. However, I know a number of people who use them on shorter-term bars, such as 5-minute and 60-minute bars. George Lane, the inventor of stochastics, used to use stochastics on 3-minute bars in the S&P 500 futures. How to use stochastics as an overbought and oversold indicator. Stochastics can be used as an overbought and oversold indicator. This is the most common use. The underlying idea is that a market will not normally move in one direction or the other for very long without running out of buyers, in a bull move, or sellers, in a bear move. If the market shoots up sharply, without a retracement, then the market is considered overbought. Conversely, a sharp drop in price, without a retracement, will lead to an oversold market. The basic theory is that prices cannot go too far too fast. If they do, then they are ripe for a retracement. The retracement is necessary to correct the overbought situation. A market that has shot up quickly has moved the price of the pair away from the underlying value too quickly. As a result, the market will set back slightly to induce more buying into the market. The concept of overbought and oversold is mainly used to try to predict short-term price movements against the trend. It is also used to help dissuade traders from buying the market after the market has moved strongly. It is used to encourage traders to wait for a setback before buying. In general, the concept of overbought and oversold works. Typically, when the stochastics get above 80%, the market is overbought. When stochastics get below 20%, the market is oversold. You should normally expect a correction to ensue relatively soon. This is the way that most people use stochastics. However, just because it generally works and calls corrections accurately doesn't mean that it is profitable. In fact, selling when stochastics get above 80% and buying when stochastics get below 20% is a money-losing strategy. Some people modify the method and sell when the stochastics get above 80% and the percent K crosses down below the percent D, and buy when the stochastics get below 20% and the percent K crosses above the percent D. This works better but is still a money-losing strategy. The problem is strongly trending markets. Using stochastics as an overbought, oversold indicator falls completely apart. In other words, the concepts of overbought and oversold work during mild trends and sideways markets but do terribly during trending markets. In fact, some people have suggested that you are better off buying when the percent K crosses above the 80% line and selling when the percent K crosses down below the 20% line. This is actually better than what we have been talking about, but it also loses money. First, you must determine what kind of trader you are before using stochastics as an overbought or oversold indicator. You should consider using stochastics if you are the type of trader who wants to buy dips and sell rallies in trendless markets and is willing to lose when the market finally starts to trend. If you are a trend follower, then you should ignore the stochastic overbought and oversold reading. Stochastics will register an overbought reading for weeks during a major explosive bull market. The more explosive, the more the indicator will falsely be considered overbought. Figure 5.1 is a good example of what I have been talking about. The market became overbought in mid-December and the market continued to skyrocket. On the other hand, the oversold conditions in February showed some promise as profitable trades. The bottom line is that it is dangerous to trade just because the stochastics have moved to overbought or oversold. There needs to be some trigger to tell you when the buying has actually begun to dissipate. Otherwise, you will often be selling into a strong market with strong momentum. You know you are selling into a strong market when you sell an overbought market, but you want to have a sign that the momentum is waning and the retracement is now going to occur. The crossover is that signal. Let me show you how to really drill down on using crossovers as signals. I told you that this is not a profitable method to use mechanically, so be careful. However, there are times when you can use it to your advantage. I'm going to drill down to show you some nuances when you're using this technique. But don't make this a primary technique, it's dangerous. Trading signals from crossovers. Perhaps the most common use of stochastics is to give trading signals derived from the crossover of the slower moving line, the %D, by the faster moving line, the %K. The idea is that you sell the market when the %K crosses below the %D and buy when the %K crossed above the %D. It is usually considered that the best signals come when the stochastic crossover occurs when the stochastics are above 80% or below 20%. These two levels give the most room for the signals to make money since the signal occurred when the market was overbought or oversold. Once again, I am not sure that this is so since selling into overbought bull markets is a dangerous game. Still, those are the usual rules. Sometimes the %K will cross the %D when the %D is still climbing. This is called a left-handed crossover because the %K crosses over the %D on the left-hand side of the hump created by the %D. This will occur when the price changes sharply in the other direction. A right-handed crossover comes when the %K crosses over the %D on the right side of the hump of the %D. Figure 5.2 shows examples of both types of crossovers. Most analysts prefer the right-handed crossover because they believe that it is a more stable market and that they are entering the market just after the turn in prices. A right-handed crossover will only occur when the market stabilizes first and then starts to drop. A right-handed crossover will also have the benefit of usually having both the %K and %D moving in the same direction when the crossover occurs. It is for this reason that many investors prefer right-handed crossovers. It means that the momentum has changed significantly and that a trend has likely started. However, the inventor of stochastics, George Lane, has suggested that it is acceptable to trade a left-handed crossover if it represents a resumption of the main trend. In particular, he suggests using it when a classic divergence, to be discussed next, has occurred and the left-handed crossover represents a resumption of the trend. Stochastics can also cross over in the middle of the range between 20 and 80. They don't have to cross over only in the extremes of the stochastic range. Crossover will usually occur in the middle of a major trending market, that is, the market moves strongly in one direction, reverses, and then takes off again. Stochastics can give a sell signal during that retracement only to reverse back to the direction of the trend immediately after. Generally, the idea is to buy or sell on the crossover and liquidate the trade on a crossover in the other direction. Obviously, this doesn't give much protection against sudden and strong moves in the wrong direction. As a result, many traders put in some protective stop based on recent price action, such as support and resistance, as disaster insurance against such a powerful move against the position. Let me go back to the concept of trading crossovers in the middle of the range rather than at the extremes. I like this method because we are no longer using the concept of overbought and oversold, which I believe is very dangerous to our equity. But let's get back to the concept of using stochastics to tell us the momentum of the market. We see that there is a strong trend in the market and that there has been a retracement. Now we want to use a crossover in the %K and %D only in the direction of the trend to enter a position. We have essentially used the stochastics to time the end of countertrend move and then get back in tune with the strong underlying trend. This way of using stochastics is very profitable. Please note that you need to find another way to set a protective stop. Typically, you will use the low of the countertrend move as the stop. Profitability of stochastics. There have been few studies of the profitability of using crossovers for trading signals. One study was done by Robert Colby and Thomas Myers in their excellent book The Encyclopedia of Technical Market Indicators, McGraw-Hill, 1988. They focus on the stock market, so they use the New York Stock Exchange, NYSE, composite index for their study, pulling monthly data. They tested period lengths of 1 through 24 over the period 1968 to 1986. My only criticism of the study is that they used monthly data rather than daily or even weekly data. The results were very interesting. The first rule they tested was a simple crossing of %K above or below %D. They optimized the results and found that every time period was a loser except at 21 months. Clearly, this method should be discarded. The authors then tested a more robust rule of requiring that both the %K and %D had to be rising for a buy signal and dropping for a sell signal. This tends to mean that trades will be in the direction of the longer-term trend. What they found was that every period length was profitable except for the shortest lengths below 6. Adding this new filter significantly improved the value of stochastics. Obviously, many investors will not want to trade in a market using a monthly signal, but even these people will want to consider using this as a powerful trend indicator to filter short-term trades. In other words, take short-term trades only in the direction of the long-term trend as identified by the long-term stochastic crossover. Note, too, that this monthly method can be used to time longer-term trades such as Forex hedges for corporations. They then tested the signals on weekly data over 2 different time periods. In this case, only signals around 50 weeks were profitable. Longer and shorter lengths were unprofitable. I think we can safely conclude that we should ignore this method. Just because these tests were with stocks doesn't mean that they aren't important for us Forex traders. But markets are markets. They are all traded by humans. Techniques in one financial arena very often work in other financial arenas. Colby and Myers also tested the concept of selling overbought markets and buying oversold markets and found that it was a huge loser. Let's just stick with following the trend. Warnings. Because it is an oscillator, many traders look at the slope of the stochastics for an idea of the momentum of the market. They want to, say, buy when the stochastics are trending down but the momentum of that trend is waning. In effect, they don't want to wait for the crossover to get long. They want to get a jump on the stochastic crossover. In other words, they will start to sell a market as the stochastics start to slow their advance. Take a close look at Figure 5.2. Notice that the %K will start to slow down its advance or decline while the %D is still moving at the same rate. Selling or buying when this happens will certainly give you a jump on the market change. Not many people use the change in the slope to actually enter or exit the market. The main use is as another indicator to help predict the market's near-term direction. Obviously, there are 2 main problems. First, there is the usual problem of selling into a major bull market. Second, occasionally the %K will reverse quickly and move again in the original direction. This is called a failure, and I'll discuss this next. The best way to make money using stochastics. Now we get to the fun stuff. This is the real way to make money using stochastics. Let me first describe what divergences are. One of the most popular modes of using stochastics is divergences. A divergence occurs when the price and stochastics diverge from following roughly the same path. In other words, if the price makes a new high but the stochastics don't, you have a divergence. If the stochastics make a new high but the price doesn't, you have a divergence. Divergences are mainly used to predict and trade a change in trend. The typical divergence is when the price makes a new low but the stochastics don't, or the price makes a new high and the stochastics don't. In other words, the momentum of the price is less strong than the price itself. There are no specific entry and exit rules, but I'll show you how to use stochastic divergences to create massive profits. We'll have to use other techniques to actually create the timing. We'll use stochastics to create the environment for making extra money. I have studied this type of divergence and have found that divergences on the daily chart mean something different than divergences on the weekly chart. Divergences on the daily chart typically mean only that the market will likely have a short-term countertrend move. In general, I look for the market to change direction in 1 to 5 days, but most likely in 2 to 3 days, and have a 1 to 5 day countertrend move, but most likely a 2 to 3 day countertrend move. A weekly divergence usually means that an intermediate-term trend change is about to happen. At the least, a weekly divergence means that there will be a significant countertrend move. I think that the size of the countertrend moves on the daily chart is not powerful enough to overcome the countertrend nature of the trade as well as the problem of deciding when the countertrend will begin. On the other hand, the size of the projected weekly countertrend or new trend move was substantial and very tradable. There still remained the problem of being able to predict when the divergence would actually create the resulting change in trend. Nonetheless, a weekly divergence is far more tradable than a daily divergence. It is a common belief that divergences do predict changes in trend, even if only a short countertrend move. But it is important to realize that you can't simply buy or sell when the divergence occurs. In virtually all cases, the market continues its trend for several more bars before succumbing to the power of the divergence. Many traders point out how great divergences called highs and lows, but few, if any, argue that the divergence actually lasted for some period of time before the price turned direction. Let's look at a couple of examples. In Figure 5.3, we see the price make a significant low about 9 bars from the left, mid-December. The stochastics also make a low. However, 6 bars later, the market makes a new low close while the stochastics have not. Note that I said a new low close, not a new low. That is because the relationship of the closes to the closes is the important factor, not the relationship of the lows to the lows. This is because stochastics are based on the closing price. In this case, there was stochastic divergence, but the price did not make a new significant low for 3 more bars. In our study, the divergence came 3 days in advance of the actual bottom. We then measure the distance from the actual bottom to the subsequent high to get an idea of the magnitude of the countertrend move. We measure this as a percent of the price of the underlying instrument to normalize the study over many futures contracts. For example, a move from 100.00 to 101.00 on the bonds would equal 1%. Obviously, this is not perfect, but it is still indicative of the magnitude when tested over 30 futures contracts. Look at Figure 5.3 again and you will see several other divergences. The most significant one is the one about 3/4 through the chart. The market leaps to a new high with a very wide range bar, but the stochastics do not make new highs. Eventually, a high is made and the market sells off, but not before mounting a very strong rally. In our study, we went back over 1 year of data on about 30 different commodities. These commodities were in various types of markets: bull, bear, and chop city. As a result, we get a good indication of the validity of using stochastic divergences. First, we tested divergences on daily charts. We found 58 different divergences. They led a turn in the market by an average of 4.5 days with a standard deviation of 5.7. However, the mode was only 1 and the median was 2. The longest lead time was 22 days. As you can see, the lead time of daily divergences was random. This tends to reduce the value of daily divergences. There were obviously 58 retracements from these 58 divergences. The average percentage retracement was 5.9% in a range of essentially 0 to a 21% retracement. The mode was 4% and the median was 5%. The reliability of the retracement figure seems reasonable even though the standard deviation was 4.4%. There were a lot more weekly divergences than daily divergences. We counted 124 during our sample period. They led turning points by an average of 2.8 weeks with a standard deviation of 3.4 weeks. The range was from calling the turning point exactly to 16 weeks in advance. Actually, the mode was calling the exact turning point. In other words, the most common occurrence of a weekly divergence was that week was the actual turning point, which is very interesting to me. The average retracement of the 124 retracements was 15.3% with a standard deviation of 13.6%. Obviously, this is a far more powerful indicator of subsequent price movements than the daily divergences. The mode was, however, only 4% with a median of 11%, though the maximum was 80%. Talk about a big move. I'm about to say something that is astounding and perhaps heretical. It could be that divergences are simply illusions. Perhaps we are creating a pattern where none exists. For example, I could create a system that predicted a countertrend move soon after every day named Tuesday. Well, sure enough, this system will call 98% of every countertrend move within 2 weeks. In other words, only rarely will a market go 2 full weeks without retracing at least one day. Be aware of this potential problem. Having said that, I continue to use stochastic divergences on the daily and particularly on the weekly charts because I am making money using them. A failure occurs when the %K changes direction, doesn't cross the %D, and reverses back to the original direction. Figure 5.4 shows 2 different failures. Arrows in the stochastic part of the chart show the failures. The first one occurs in early March when the %K actually drops but does not actually cross the %D. The second one occurs in late April. This is not a classic failure because it doesn't actually drop but it doesn't sharply slow and almost cross the %D. They often occur when there is a sharp retracement against the main trend but then an equally sharp resumption of the main trend. The classic interpretation is that failure shows that the original trend will continue and that you should trade in that direction. In this case, that means jumping in the direction of the trend as soon as the %K resumes its original trend. Go with the trend. I sometimes use stochastics as a mechanical trading system or as a trend indicator. The basic rule is to buy when the %K stochastic crosses above the 50 line and sell when it crosses below the 50 line. You are always in the market. I use this rule on both the weekly and daily bars, but mainly on the daily ones. My experience is that the performance is similar to using any intermediate-term trend following system. You will get chopped up during sideways price action but will make major profits when the market gets into a major trend. Colby and Myers tested this concept on NYSE Composite weekly data. See the appendix for more information. They add one additional filter. The %K and the weekly closing price are above their previous week's level. Their results were that this was a profitable system using just about any length of parameter. This shows that the method is robust. However, profits were best near the 45-week level. Colby and Myers point out that only about 39% of trades were profitable. That is about what you would expect from any intermediate-term trading system. The conclusion: this is a solid trend-following system that can be used on both weekly and daily data. The percentage of trades that are winners will be near 40%, but the winners will be greater in size than the losers. One great advantage of this method is that it is free with every charting service. How I use stochastics. I pay attention to stochastics every day. I look for both daily and weekly divergences, in particular the weekly divergences. I look at the daily stochastics most often because that is the chart I mainly am living with day in and day out. On the daily chart, I am mainly looking for divergences. Let's say that I see a divergence and I already have a position on, and this position comes from a long-term technique like channel breakout. In this case, I would take off part of the position, perhaps 1/4 to 1/2 of the position. This should be a profit-taking exercise. My idea is that the market will set back for a few days. I will take some profits now and re-enter those liquidated positions should the market break to new highs. Let's assume that I am right and the daily stochastic divergence actually causes the market to dip. Hopefully, that will cause the stochastics to cross down. I can then use an upside crossover to trigger a re-entry buy order. If the stochastics do not cross down, then I will rebuy the sold position when the market makes a new high. Now, If I have no position but I am about to have a trade based on one of the core position methods, I want to follow the method and get long when the market breaks out. But I see that there is divergence developing, which suggests that the breakout will fail at least for several days. I will go ahead and enter the buy order, but I will cut the position size in half or thereabouts. If I get into a position and there is the setback that I expect, then I can buy the rest of the position if the market makes a new high. On the other hand, I will only have a half-size position if the market continues higher. That situation is rare because daily stochastic divergence will usually cause a setback. So, basically, I use the daily stochastics to modify my already existing trading methods. Weekly stochastics are far more powerful than daily ones since they lead to either a significant retracement or a major trend change. My trading strategy here is to use them the same way I described using the daily stochastics, but I will also become aggressive at finding an entry point in the direction that the divergence is predicting. For example, let's assume that the market is moving higher but develops a bearish stochastic divergence. That would predict at least a strong retracement that is big enough to make a nice profit. If I am long, I will look for any excuse to exit the long position. If I have no position, I will look for any excuse to get short. This is more aggressive than the techniques outlined in earlier chapters. By any excuse, I mean that I will take any technique outlined in this book and jump on the short side with little or no confirmation. For example, the market is heading higher but a divergence appears. I'll get short if I see something like a reversal bar down on the daily chart. It doesn't have to be much of a signal to get me short. I'll also use that signal to exit my position trades from techniques such as the Conqueror or trend analysis. Interview with George Lane. I was fortunate to get a phone interview with the inventor of stochastics, George Lane. He was quite old at the time and has since died. He was a great character. He was mainly a trader of Standard & Poor's, S&P, futures, but his comments applied to Forex trading. The interview is word for word, so some of the grammar is fractured and there is some stumbling that is natural in spoken English. Author: Are stochastics your primary form of analysis of the market? George Lane.
Oh, yes. It beats everything else I've discovered or tried. It's damn near infallible, once you get to know how to use it.
Author: Do you use it mainly as a trend indicator or overbought, oversold or crossovers or what? George Lane.
I'm a short-term trader. We trade about 3 or 4 times a day. I use it to signal buys at the bottom. I day trade S&Ps.
Author: Do you use crossovers to signal the buys? George Lane.
Why don't we take out the word crossover out of it? The crossover happens, but that isn't the signal. The signal is divergence.
Author: Does the divergence have to be in overbought or oversold territory, or can it be anywhere on the chart?
Most of the time, it will be in the overbought, oversold territory. Those are the safest. We take some in the mid-range.
When you see a divergence, will you then use a crossover to signal an entry?
No, just the divergence.
So, you will buy or sell just as soon as you see the divergence.
You have to combine old-fashioned charting with stochastics, and it's damn near infallible.
So let me get this straight. I'm seeing a divergence on the downside. Will you then be looking for a reversal bar or breakout above a previous high after you get the divergence?
Yes, or at the same time. Stochastics is a hair early. It's a leading indicator. A lot of times you will get your stochastic divergence, and then 1 or 2 bars later, you will get your chart signal.
Do you find that is the case on dailies and weeklies as well as on shorter-term bars?
Absolutely. I use exactly the same technique on long-term as I do on short-term.
Do you feel that the crossover of the 50% level is of any significance?
No. Once it breaks the 50%, I know I'm right. I don't put much weight on it.
Do you ever look at right-handed or left-handed crossovers?
Yes. Say the market comes down and makes a great big double bottom. At the first bottom, you're going to have a left-handed crossover. That tells you, wait. you're going to get a right-handed crossover, and that's going to be a better signal. So you wait for the second bottom of the double bottom, get the right-handed crossover, and then you go.
So the right-handed crossover is more significant.
It is the important one, yes, sir.
Some people say that when the stochastics first cross 80%, that is a good time to buy, and that is a good trend signal.
That's Jake Bernstein's interpretation. He discovered, and we have been teaching for 47 some years, that sometimes stochastics goes on up to the top and the market keeps on going. In other words, there's just so damn much momentum to it that it just keeps on going. Stochastics, when it gets up around 100, can't do anything, so it just bobbles along the ceiling. That kind of thing happens, and they are marvelous. So when it gets up around 75, he's a buyer. If I bought one down near the bottom, I can buy another one up there, but I have a little trouble buying the first one up there.
What about the formation you call a knee or a shoulder or failure? Do you see that very often, and do you find it worthwhile?
Yes, sir, it happens. It doesn't happen very often, but it does happen. You see, if the market... Yes, sir, it happens. It doesn't happen very often, but it does happen. You see, if the market comes down and gives me a left-handed crossover, I'm going to wait for the right-handed crossover. But then K rallies and then comes back and kisses D and then starts to go back up again. Now I have a convergence in K only. So I jump on it and go. It means that we might not get that right-handed crossover because I got a legitimate right-handed crossover in K. You take a divergence in K or D or both. So if you don't get your divergence in D but do get it in K, go.
Let's say you have entered a position on a divergence. How do you set your protective stop loss?
2 clicks below the lowest of the 2 previous lows.
Where did the name, stochastics, come from?
Stochastics is an advanced form of statistics. In statistics, every so often they run across a situation that has so much data that they have to use other ways of studying. I sat next to a stochastics engineer flying out to San Francisco one time. He explained it to me as an advanced level of statistics. He was going out to redesign the lenses of the Hubble telescope because the data of all the stars in the sky was so enormous that they had to change things a little bit. That's a good illustration of where they use it.
Who came up with the name, stochastics?
Stochastics is that discipline in statistics or engineering that they use. Percent deviation, or percent D, is the name of the indicator. Percent deviation from normal.
That's percent D. Where does percent K come from?
Somebody in the pit one day said that they wish they had a leading indicator for this darn thing. I looked and it was right there in our calculation, so I named it after my middle name, Kelly. After we used it for a few years, CompuTrack gleamed onto it in their committee of 30 and suggested they use it. When they got it all programmed and ready to use, Tim Slater asked them what are they going to call it, and the guy said that he thought it was a stochastic type thing. So they called it stochastics. It's not a stochastic type indicator at all, but it got that name and it hung on. I didn't have any control.
What is the relationship of stochastics with Larry Williams's percent R?
The first thing we discovered was percent R. We discovered that in 1948. Percent R is stochastics upside down. We used it for a while. When you make a signal at the top, you buy, and when you make a signal on the bottom, you sell it. So we turned it right side up to make it more practical. We had written some stuff on it. I think that one of Larry's friends came to one of our seminars and took it home, and Larry thought it was a good thing and published it and put his name on it.
Is stochastics a better oscillator than a rate of change or RSI?
Wells Wilder's RSI is a damned good indicator. It's nothing but a closing price chart. If you take off the open, high, and low and make a chart with just the close, you're going to get the same type of pattern that you get with RSI. It will show the divergences and things like that. So a closing price chart was used early in my experience. It was a good indicator. Wells Wilder's RSI is a complicated way of figuring that. It's a damned good indicator, but it's a one-line indicator and it fails maybe once every 20 times to give you a good clean signal. Whereas stochastics just damn near never fails. We used RSI along with stochastics for several years, but we finally came to the conclusion that we don't need two oscillators, so we just quit using RSI because we don't need it. I used volume instead of RSI.
How do you use volume?
Volume is a very standard thing. We've been teaching that for 45 to 50 years.
What term stochastics do you use? Most chart services use either 9 or 14 days.
Well, a charting service has to have them all the same because they use a computer to generate the charts. What you do is look at the chart. Let's say you are looking at dailies. You look over a few days and locate the cycle. The cycle that you see, not necessarily the cycle that the guy in the next desk sees. The rule is, in analysis, when you are working on an indicator and there is a moving average in the indicator, to smooth or optimize it, the input data for that indicator will be 50% of the cycle that you are trading. So you just look at the charts and find the cycle. There is usually a cycle that is fairly common. It may vary a little bit, but it is fairly repetitive. You take half the number of bars of the cycle, and that is the input data for the stochastics. Now you are designing the stochastics to fit the cycle that you see. Therefore, that will be the most successful for you.
What does the cycle length have to do with anything?
The rule is in the analysis of oscillators. Whenever you are developing an oscillator of any kind, the input data to calculate that oscillator is going to be 50% of the cycle you are trading. Then you will have the most optimum oscillator.
Is there any particular reason why that should be? Why not the full cycle?
You've got moving averages in your oscillator to smooth it. Anytime you use a moving average, like the 10-day moving average, you are going to be 5 days behind the last trade. So you take the input data that shows your last trade, which, on a 30-day oscillator, will be 15 days back. So that seems to be the most successful. I've researched that for years and I haven't changed it.
So each commodity will have a different length for calculating the stochastic?
This makes stochastics a little more successful and a little more reliable than just arbitrarily picking a number.
In general, would you say that the chart services have selected a good average at about 14 days input?
I think that looking at the daily charts, 14 or 15 is a pretty good average. It's usually a 30-day cycle. I used to trade the S&Ps a few years ago and they had a 28-day cycle. It lasted for 4 or 5 years. Now, of course, with the volatility that the S&Ps are in now, the cycle has shrunk to less than 28 days. We are getting very volatile markets. We are at the end of a 60 or 70-year cycle, and this is the blow-off period, and things are getting wild, as you know.
Who invented stochastics?
I did.
When was that?
We started on this in about 1948.
How did you come up with the concept?
Well, there were 6 of us, and we traded on the Mid-America Commodity Exchange. Every night, we would go over to investment educator's office. We were trying every damn fool thing we could think of. We were using the alphabet. We had reduced everything to percentage because then the range would be from 0 to 100 and it would make the oscillator more practical. We went through the alphabet, I think, twice. We had an old Czechoslovakian immigrant there who was a friend of one of the Polish boys that was kind of helping me. He told us, in his broken English, about a formula that they used in Czechoslovakia to figure out how much limestone to put in the steel mix when they were melting iron and stuff to make steel. We took that stupid formula of his and readjusted it and played with it, and that was the tip-off for what is now stochastics. We were desperate. We were grasping at straws because we knew that there was something out there, but we just couldn't find it.
Who else was involved?
There were about 4 or 5 people helping me or doing the same thing. They were all Polish people. Gosh, I don't even remember their names anymore. I know one of them went over to the Chicago Board of Trade and got to be a big player. I remember one day he had a big position and he wanted to go and visit his girlfriend up in Michigan and told a buddy of his to get him out of his position. His buddy forgot to get him out and the market opened the next day and went straight down for 3 days and he got wiped out. So he quit and went back to teaching. He lost $360,000 in just 2 or 3 days. I felt so sorry for him.
When was that?
Oh, that was in 1948 or 1949.
So that was real money then?
Yeah, that was huge money. And he was a damned good trader. He was using stochastics very well.
What did you call stochastics back then? %D?
As soon as CompuTrack came out with their software and called it stochastics, I had no choice but to call it stochastics. But I called it %D until CompuTrack gave it a name. The most popular oscillators are stochastics, RSI, and MACD. RSI is damn near as good as stochastics, except that it is a one-line indicator, and it is much easier with stochastics because it has 2 lines and it can give you 2 signals to do something. MACD is a very fine oscillator, but it's quite late. By the time you get signals to do something with MACD, it's already gone. Those are the 3 most popular. I think that CompuTrack did some research and asked about 9,000 of their members, and I think that stochastics was number 1 and RSI was 30 points behind that, and then MACD was 50 points behind that in popularity. Do you know that every mutual fund is using stochastics? I hear from some of them every once in a while. They call me up and thank me for inventing this marvelous indicator, and they use it all the time. I think that it is the most universally used because it is in every software program.
Any other comments you can pass on to us?
We've just developed the methodology of trading. We trade 3-minute bars on the Swiss franc and the S&P and stuff like that. We use stochastics and volume and normal charting techniques and patterns, and we find that those 3 things together are almost awesome. They will sometimes go 2 or 3 weeks without a loss.
Doing day trades?
We trade an average of 4 times a day. I traded the 1-minute bars one day, and it gives you a lot more signals. I think I had 38 trades. I think I made money. I know the broker did.
I know one thing, and that is that the broker always wins.
Isn't that wonderful? When you win, he wins. When you lose, he wins.
Well, George, now I know why you were in the brokerage business for so long. The bottom line. Stochastics are an interesting technique. It is amazing that they are so popular yet are so misused. I think that George Lane and I have shown you how to use them properly and profitably. End of Chapter 5.